Chalo, 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 chalo. Good morning, everyone. Good morning, each and everyone.
Morning, sir.
Good morning, sir.
Good morning, good morning, good morning. So today the agenda will be what? To do the IAS 60. Not what is financial instrument? IAS 12. Then your IAS 19. Then we'll do IAS 36, IFRS 5. These are the important topics which we'll be doing today. So now, for financial instrument, let me go with the basics first. Chalo now, starting with financial instrument. This topic is very important for SBR. Here, calculations will be less in your exam, but the theory will be more. Like the examiner would give a question saying that whether it's a equity or liability, or you could have a hedge accounting theory, or you could have impairment theory, or you can have modification of debt, etc. We will discuss now. IAS 32, IFRS 7 and 9. So now financial instrument. IAS 32 will cover what? IAS 32 will cover financial instrument presentation. It will discuss about the presentation, whether it should be required as an equity, liability, or as a financial asset, financial liability, equity, etc. Then IFRS 7 will discuss about the disclosure part. IFRS 9 will be regarding the calculation of financial instrument. So IAS 32 deals with the classification, IFRS 9 deals with the measurement and how it will be recognized, and IFRS 7 deals with the disclosure part. So what is a financial instrument, sir? A financial instrument is a contract which gives rise to both a financial asset for one entity and a financial liability or equity instrument of another entity. For one party, it will be what? For one party, it will be a financial asset. For other party, it can be financial liability or equity instrument. Then, if you have seen a lot of questions, whenever a question comes regarding financial instrument, write down this. You would have 0.5 marks, technical marks for writing this. If what? If the question is regarding theory that identify whether it's a financial instrument or not. In that case, instruments include primary instruments like receivable, payable, equity securities. Derivative instrument includes financial options, futures, swaps, and forwards. Now this I mentioned, it is not tested for FR, but it's very important for SBR. If it's your very bad day, we say that hedging can come, but it's very easy. Follow these steps, follow some simple points, write down that, you will get the marks. Then statutory right or obligation will never create what? A financial asset. If you have a tax payable, if you have a tax receivable or a tax refund, in that case it will not be a financial instrument. So now what is financial asset? Financial asset is a cash, contractual right to receive cash or another financial asset from another entity. That means today I have a receivable from you. That means it's a contractual right to receive cash or another financial asset from another entity. That means from other entity, I have to receive, either I have contractual right to receive cash or any other financial asset. In that case, instead you will not give me cash. You will say that, sir, we have a receivable from someone else. That receivable we will give you. That becomes another financial asset here. Equity instrument of another entity. If you have invested in any company shares, it will be treated here. Then contractual right to exchange financial asset under potential favorable condition. This will be regarding derivative. If you're doing some betting, in that case, we can say this. And that also should be for financial asset only. For non-financial asset, we have further conditions. We will see in derivative part. Then certain contract which will or may be settled in the entity's own equity shares. If today I've given a loan today to you, you say that, sir, in future we will do the settlement of this loan in your own share. That means my company share, our limited shares will be giving. In that case, also it will become a financial asset. The next one, what is a financial liability? Financial liability is what? So financial liability is a contractual obligation to deliver cash or another financial asset to other entity. That means you have to give what? You have the obligation to deliver cash or any other financial asset. Contractual obligation to exchange financial instrument, and it is unfavorable here. It's unfavorable. If it is unfavorable, then it becomes what? A liability. If it's favorable, it becomes a asset here now. Understand? Then certain contract that will or may be settled in own equity instrument. Okay, that will be settled in own equity instrument and it should be in variable number of shares. It should be what here? Variable number of shares. Then equity instrument, when will you say it's a equity instrument means residual interest in the asset of an entity after the deduction of all its liability. So contract to issue fixed number of shares. In your exam, if it's mentioned that the variable number of shares are given, then it's a liability. If it's a fixed number of shares, it is what? Equity. If it's a fixed number of shares, it is what? Equity. So remember this point. If you have solved your past papers, you would have seen that this question being tested 3 to 4 times. So if it come also, it will come for 4 to 5 marks, not more than that. Then a lot of example we have taken. So what is important here? And see now, income tax payable and refund is not a financial instrument. Is not a financial instrument. If it's a gold is also not a financial instrument. But if you have invested in gold bond, then it is a financial, a certain financial instrument. Then coming to classification. In financial asset, for one party it is a financial asset, for other party it is a financial liability or equity. So financial asset, in financial asset, you have three types of classification. Amortization cost model, fair value through OCA, fair value through P&L. For financial liability, we have what? Amortization cost, fair value through P&L. This fair value through P&L will be used for derivative and for trading purpose. For equity, initial amount, the value will never change. The value will never change. Now, under financial asset also, further we have the classification of two things. Debt instrument and equity instrument. In financial liability, only financial liability and equity. So for one party, it's a financial asset, and for other, it's a financial liability or equity. And under financial asset, two categories, debt and equity. Let us see now. Financial asset. Let me first do financial liability. Let us first do financial liability revision so that the financial asset will become easy. Compound instrument. See here now. Financial liability. So financial liability, when we will recognize financial liability is recognized only when an entity becomes a party to the contract. Which contract? Financial instrument contract. In the this is for FR exam, but for your SBR exam, amortization method also can come, or fair value through P&L also can come. So see now the measurement part, very important. Measurement, initial measurement. Initially, we record financial asset and financial asset and financial liability at fair value. And subsequent, either we follow amortization cost model, either we follow what? Your fair value through P&L or fair value through OCI. In your financial liability, only two methods, amortization cost method and fair value through P&L. So initial measurement, financial liability is initially recorded fair value. So fair value means what? Whatever is the price minus the discount. So here basic sense you have to remember what is the net proceed you receive. What is the net amount we receive in our pocket. So issue proceed minus transaction cost. If today I say that the loan had the company is issuing bonds. If the company is issuing bonds, that means for the company it's a liability. For the person who is investing, it's a financial asset. So on this bond, the company has given 1,000 rupees discount. So 9,000 is the value, and the company has incurred some transaction cost. So the transaction cost you will reduce here. I say 500. So what is the value? 8,500. At 8,500 we have to record this fair value. See, if the financial liability is classified as fair value through P&L on the initial date only, if the company is saying that we will follow fair value through P&L, we will not follow amortization cost method. In that case, the transaction cost will be directly taken to P&L as an expense. In which category? Financing category. For amortization cost method, what we do, we unwind it on based of EIR. This will be given in the question, and the interest will be paid on the coupon rate. Interest will be paid on the coupon rate. For fair value through P&L, what we do? For fair value through P&L, we take the difference into P&L, and it is for short-term liability like your derivatives, and finance cost will be recorded based on coupon rate here. Here, finance cost will be recorded in EIR rate based on EIR rate. Here, finance cost will be recorded based on what? Coupon rate. So see, this is the table. So EIR rate will include what all? EIR rate will include your coupon rate, discount, transaction cost, and redemption premium. So actual payment is done on the face value by using the coupon rate. Let us take an example. A company issued bonds with the following terms. Face value is how much? The face value is $20,000. Coupon rate is 4%. Term is 5 years. EIR rate is 7%. Transaction cost is how much? Transaction cost is 534. Discount is 500. Redemption premium is 10% of the face value paid at the end of the is 10% of the face value at the end of the fifth year. So see here now. So we have calculated the face value is 20,000. Discount we have reduced. We got the fair value of the liability. Then we reduce the issue cost. In case of financial liability, we reduce the issue cost or transaction cost. But in case of financial asset, we add it. Why we reduce it? Because the expense should be recorded over the period. It's like amortizing it. So we get this. This is the net proceed. So my actual interest will be how much? Actual interest will be, sir, on 20,000. You will not take actual interest on this. 20,000 into 4%, you get 800. At the end of fifth year, what is the amount that should we repay? So 20,000 plus redemption premium of 10%, we will pay that. That is 22,000. So see, Anna, this is the way we do the calculation now. So year one, opening balance we have, finance cost, we have payments of actual interest, and closing balance we have. So opening balance we have taken at the fair value less transaction cost. Then every year you unwind it using the EIR rate, and then payment is based on the face value and the coupon rate. Our face value was 20,000 and the coupon rate was given, so we have calculated. Then you have the closing balance. This closing balance will present in the non-current liability. This will be recorded as a finance cost in financing category, and this will reduce the cash payment. So this is the journal entry which we pass in combined. Either you can pass single journal entry, no issues, or combined journal entry. If the question mentions that pass the journal entry, sometimes in SBR for financial instrument lease, we have seen that the examiner asks for hedging also to pass journal entries. So now with this, I hope it is clear to everyone the amortization cost method in case of financial liability. And the fair value through P&L, what will happen for fair value through P&L? A simple calculation. In case of fair value through P&L, whatever is the transaction cost, immediately will take to P&L, and the interest will be based on what? The interest will be based on the coupon rate only. And it will go to financing category. For financial liability, everything will go to financing category. When coming to financial asset, it will go to investing category. Now let me start with financial assets. Now, when will the company record a financial asset? The company will recognize a financial asset in the balance sheet when it becomes an entity to the contract. Which contract? Financial instrument. So financial asset, two types are debt instrument, equity instrument. So debt and equity instrument, debt instrument, three models: fair value through P&L, OCA, amortization cost method. But for equity instrument, we can only follow two methods. That is fair value through OCA and fair value through P&L. Now, in your exam, in your SBR exam, calculation will not be much, but sometime a case scenario could be given and they will ask you, or you should mention whether we'll follow amortization cost method or fair value through OC or fair value through P&L. Now, to decide whether which model will we follow in debt instrument, we have two important tests. Amortization fair value through OCA will depend on these two tests: BMT, business model test, and contractual cash flow test. So now what does BMT means? Business model test means what is the purpose? Will the company hold this till the maturity or not? Will the company, the holder of the bond, will they hold this till maturity? Then contractual cash flow test means what? What is the amount they will receive? So the principal amount they should receive, and they should receive what? The interest amount. Either the company can sell also, but to meet the criteria for BMT and contractual cash flow, the company should hold this till maturity, and they will only receive what? They will only receive contractual cash flow, that is principal and interest payment. So in amortization cost model, so entity must hold the investment till maturity. Till maturity they have to hold. Then intention is only to collect contractual cash flow, interest and principal. But sir, in fair value through OCA, what can happen? The company will have the intention to hold till maturity. But if any better opportunities available in the market, they will sell it. If any better opportunities available in the market, they will sell it. So intention to collect contractual cash flow. The intention is to collect contractual cash flow. But if they have an opportunity, if they get a better opportunity that we will use this, they can consider it. No issues in this. Then we'll follow fair value through OCI. Then fair value through P&L. Intention is to hold the asset for trading purpose only, and the contractual cash flow test also will fail. That means the company says that we will not principally recover the amount from the principal payment plus interest. We can sell this today, we have acquired, tomorrow if we are getting very good profits, we can sell it. So in that case, your convertible bonds fails CCT test. Whenever you have convertible bonds, no, that is the reason for convertible bond we have different accounting, compound accounting. So I hope this is clear to everyone. So which model to follow? So you have to write down this. You have to write down this, what is business model test and contractual cash flow test, so that you can get 1 or 2 marks based on the question. If the question is regarding this one, they say no, a question is given and do the accounting treatment for 2000x1. In that case, you have to mention whether we'll follow amortization cost model, fair value through OC or fair value through PL. Then initial and subsequent measurement. Let us do this. So see now, in amortization cost model, what will happen? Initially, we recorded fair value. Fair value means what? Face value less discount value. Then transaction cost, we capitalize it, we add it here. Recognition of income will be based on EIR rate. Subsequent measurement is based on amortized cost. Then income and interest amount will be based on what? PNL. It will go to PNL. Which category? Investing category. On disposal, the gain or loss will be transferred to P&L. We will discuss where will this gain or loss go when we come to derecognition. In fair value through OCA, everything is same. Only what will change? Only this will change here. Whatever is the balance here, you compare the closing balance to the fair value. Whatever is the difference, you will take to OCA. And will this be reclassified to P&L? In case of debt instrument, you can reclassify this to P&L. So reclassification to P&L means what? You record in OCE or OCA first. You record in OCA. From OCA, you take to OCE. Again from OCE, you to bring to P&L. And from P&L, you take to retain earnings. This is known as what? Reclassification. If you directly record in OCA, from OCA it is recorded in OC, from other component of equity it is going to equity, it's not coming back to P&L, then it is not reclassification. In case of debt instrument, we can reclassify this. Whenever you get a question regarding fair value through OCI under debt instrument, please write down this point. You will be getting 1 marks. Even though your answer is wrong, write down that in case of fair value through OCI under debt instrument, we can reclassify this to P&L. Then coming to fair value through P&L. In case of fair value through P&L, sir, you will record at fair value. Transaction cost will directly go to P&L under investing category as an expense. Then based on coupon rate, your income will be based on coupon rate. At fair value, any difference will go to P&L, and income will be recorded in P&L under investing category, and on disposal, gain or loss will be recorded to P&L. Now, which category will be coming? Most of the time, it will be investing category only. But if it is regarding some receivables, etc., in that case, it will go to operating category. So now this is clear to everyone. Now let us do a question, so that in this question we'll cover all the three methods and what is the difference. Example, on 1st Jan 2000X5, A bought 10,000 6% bond at a discount of 1,000. A incurred transaction cost of 144. Interest is received annually in arrears. Bond will be redeemed at premium of 500 over its nominal value on 31st December 2007. The effective interest rate is 11%. So if A plans to hold the bond until the redemption date, that means A is saying that we will hold this bond until redemption date. That means business model test is satisfied, contractual cash flow test is satisfied. In that case, we follow which method? We will follow your amortization cost method. So fair value is 10,000. How much is the discount? We have got a discount of 1,000. In the case of financial liability, we have seen how much is the net amount we receive in a pocket. Here is the, what is the amount you are giving? What is the amount you are giving? So 10,000 I gave. I got a discount. So I'm ultimately paying how much? 99,000. So my transaction cost was 144. I have added it. Net proceeds given here. So then actual interest will be based on what? Actual interest received is on the face value 10,000 into 6%, that is 600. At the year end, how much is the amount I will receive? 10,000 plus premium I will receive 10,500 I will receive here. So see here now, amortization table. So what is the fair value, sir? 9,144. You will record this as a finance income in investing category, actual interest, and this is the closing balance. In your exam, if you do not have time, do not waste preparing the amortization table, no issues. Directly write down in brackets the number and write down. It will go to P&L, it will go, and the balance in the balance sheet for financial asset will be 9,550. In the brackets also, you can show the calculation. No need to prepare the table and waste your time. So now see here, in P&L first year, what is the income? Investment income in investing category. You record this, and for financial asset, first year, second year, and in the third year, it will be 0. Why? Because third year you are receiving the amount here. So total income is how much? 3156. So if you see this, if you do this total 3156 you're getting, and whatever is the 500 was your income, 1000 is your income discount, 1800 is your income, and 144 is your expense. Ultimately the income will be same only in the books. So with this was which model? Amortization cost method in case of financial asset. Now coming to, if A plans to sell the bond, if the possibility of the investment with a higher return, it's possibility, possible, it's not probable here. So if there is a better opportunity, then we will consider selling it. So this we will follow fair value through OCM. In this, what should we do? The amortization table which you prepare as per your amortization method will be same. So see here now, your opening balance will be same, your interest will, your interest value, your interest column or interest income will be same, your payment this also will be same. Then your closing balance is how much the first year? 9,550. Now in the question, the fair value will be given. So the fair value is given 11,000. What is the difference? 1,450. Where will you record this? This will be this in your balance sheet. You will record the asset at 11,000, but the difference of 1,450 will go to OCI and it will be reclassified to P&L in future if there is a balance when we dispose of the asset. Now see here. Now second year, what will be the opening balance, sir? The opening balance will become 11,000. 11,000. And the finance cost will be how much? 1,050. Yes, so
Sir, why is that 11,000?
this 11,000 is the fair value better. This we are following fair value through OCI model, no?
Sir,
So the fair
how
value,
did we get this value 11,000?
it will be mentioned in the question. Question mein diya hoga. It's an
Okay.
assumption as of now. I have taken that.
Okay.
This will be given in the
But
question.
the entire column will be given in the question.
No, every year value will be given. Every year. This is first year, second year, third year. For you, the examiner will not ask 3 years calculation, etc. 1 year calculation. They'll give you the fair value at the reporting date. At the
Okay.
balance sheet date, it will be given. So calculate the amount and compare with it and take the difference into OCI. Then next year, the opening balance will become what's 11,000. Now, will you apply interest on this 11,000? No. Avoid that mistake. What should you do? You should take the same interest income based on amortization method. If you do 11,000 into 11 percentage, you'll get some other number. But the interest income should be same as the amortization cost method and the payment will be same. But to calculate the closing balance, you will consider this opening balance. So 11,000 plus 1,050 minus 600, you get 11,450. And then again, you will have a fair value. The fair value through OCA, the fair value of the financial asset. You will follow IFRS 13 and calculate it. In that case, the bonds will be listed in some market, etc. On that basis, you will calculate. So 11,440 and it is 10,400. So can I say my value of the financial asset is coming down? If my value of the financial asset is coming down, it's a loss for me. It's a loss for me. So in OCI, I'll record this as a negative number. I will record this as a negative number. So we reduce it. Then next year, 10,400 will be your balance. Will you record on this interest? No, Baba. Whatever was the interest here, the same you take it. And then what you do, minus 600, you get the closing balance. Then you compare this with the fair value. Ultimately, at the end of the third year, the fair value will be equal to the value which you have to receive from the company. So this, so when you see, this 1,450 and 1,050 and 400 will automatically offset this account, the OCI part which you have. It will automatically become zero. If some balance is that 100 or 200, that you can reclassify to PNL once when you dispose of the asset. So see in PNL, what we record in PNL, we will record this as the income each year, and in cash flow, we say this is the outflow year. Income every year is this same, but gain in OCI you will be recording 1,450, 1,050 and 400. So gain on investment also we have to record it. So in your SOFP, what we record? 1,000, 10,400, as well as can I say in SOFP we record the OCI also. OCE, under OCE we record this balance as 1,450. Then next year this will reduce. So if reduce means how much it will remain? 400. And next year the value will become 0. So I hope the second method is clear to everyone, fair value through OCA. Now coming to the last method, fair value through P&L. That is for trading purpose for your derivative. So any transaction cost will directly be taken to P&L. Once we start derivative also, remember if any transaction cost is that directly to P&L. Then change in fair value through P&L. Whatever is the change in fair value will be recorded through P&L. Which category? Investing category. Interest income in P&L based on nominal value. Nominal value means face value or par value. Into what? Coupon rate. Into coupon rate. So see here, initial recognition is at fair value. That is 10,000 minus 1,000 is 9,000 is the financial asset. So you are paying 9,000. Then transaction cost will be directly taken to P&L. Then interest income is based on coupon rate, that is 600. Here the interest we calculated based on coupon rate. In the above two methods, it was EIR rate. So on 31st December 2000 XY, your fair value is 11,000. So how much is my fair value? 9,000. From 9,000, it's becoming 11,000. So it's increase in the fair value of the asset. So it will be what? A gain to you. A gain to you. So this where we'll record directly to P&L. Which category? Investing category. I hope it is clear, this method. So with this, the financial asset revision is done. All the three methods. For your exam, what is important? To decide whether it's amortization cost method, fair value through OC or fair value through P&L. Now coming to the next part, equity instrument. Equity instrument means purchase of shares in other entity. If you know consolidation, in consolidation, we have seen less than 20% is a financial instrument. In that case, this accounting will apply IFRS 9. So initial and subsequent measurement. Fair value through P&L, fair value through OCA. So which is the default method here? The default method is fair value through P&L. But if the company wants to choose fair value through OCA, they can select it. No issues in that. And once they select this fair value through OCA, can they shift back to fair value through P&L? Never. So whenever a question comes regarding equity instrument, please write down this point that the default method is fair value through P&L and fair value through OCA. And this, once we follow fair value through OCA, we can't come back and follow fair value through P&L. You'll have 1 marks for this sentence. It is an irrevocable option. That means once you choose, you can't change it. So fair value through P&L, initially you record at fair value whatever is the amount of the equity value. Then transaction cost will be recorded to P&L. Any dividend income which you record, you will receive P&L in investing category. Subsequently, you will measure at fair value. Any difference will go to P&L. Whatever is the value, increase or decrease in the share price, you will take. And this fair value through P&L will always be used for short term. On disposal of financial asset, gain or loss will be transferred to P&L under which category? Investing category. For debt instrument, we have not yet covered. For equity instrument, I am covering here only. So for fair value through OCA, what will happen, sir? Fair value, transaction cost will be capitalized. Dividend income will go to P&L under investing category. Now, subsequent measurement at fair value, any difference will be transferred to OCA under investment reserve. So fair value through OCA will normally be used for long-term assets. Then we have what? Gain or loss transfer to OCA on sale. Any balance in investment reserve can be transferred into retained earnings or left in equity. So see here now, what is the difference here now? The difference here is if equity instruments are at fair value through OCA, when you're selling it also, when the company is disposing of or selling them, the gain or loss is transferred to OCA. That means first remeasure the equity instrument to the fair value and then sell it. We'll do a question with regarding this also. So fair value through OCA is irrevocable option at the time of initial return. Can you reclassify this to P&L? No. Under debt instrument, reclassification is allowed. In equity instrument, it's not allowed. So now let us do a basic question, the basic example, so that you avoid mistake in your exam. So you see, A purchased shares of Reliance for 1,800 on 1st Jan 2024. On 31st 12 2024, the fair value of the Reliance share price how much? 1950. So the fair value is increasing by 150 and the transaction cost is 50. If I say the company is following the default method, fair value through P&L, the company will record investment in Reliance shares under non-current asset at 1,800. Transaction cost will go to P&L under investing category. Then at the year end, what will happen? Can I say at the year end, the value is becoming how much? 1,500? Oh no, 1,950. So the increase in the value is how much? The increase in the value is by 150. So that 150, where will you take? You will take to P&L under investing category. You will take under investing category. If I say the company is following fair value through OCA model, then what will happen? We will record the investment at 1,800. Now the transaction cost will be capitalized. 50-50. You will capitalize. You will increase the value of Reliance share price. So whatever is the Reliance investment in your books will be increased to 1,850. Now what is the value? The value is 1,950. So can I say how much is the increase here? 100 is the increase. So debit investment in Reliance shares, credit OCI or OC. Understand, OCI is not an account, OCE is an account. But in your books, they use OCI, so we also use OCI. But normally from OCI, it will go to OCE. So 100. So now you only say me how much is the value of Reliance share price. Can I say the value of Reliance share price is 1950? Now if I say the company sells this, in Reliance values how much shares? Investment in Reliance 1950. But the market value is how much? 2000. And the company is selling these shares for 2000. In that case, first increase the value of Reliance share price by 50 and take the balance to OCI. Then you say that we are receiving 2000 and we are removing investment in Reliance shares because we are disposing of. Now, how much is the total gain in OCI? In your OCI, you recorded what gain? 100 gain plus 50 gain. This 150 will not be reclassified to P&L. And do not make a mistake saying that, sir, we are selling this. So, debit, credit, bank is coming of 2000 and it is sold, the value is 1950 and 50 I will take to P&L. Do not do this mistake. It's wrong. It's wrong. In case of OCA, you can't record anything into P&L. Everything will be in OCA only. So with this, the discussion regarding this is also completed. So we have completed the accounting treatment for financial asset, financial liability, and for equity. Equity, what will you do? See, there is a difference here. There is a difference. In financial asset, you have equity investment, and on the other side, it is a equity instrument. Both are different. So in financial asset equity investment, what we do? Fair value through OCI, fair value through PIN. The normal equity which you have will be recorded at the same value. You will never change that value. Now coming to compound financial instrument. Compound financial instrument means what? The company is giving the right to the holder whether he can either take cash or either he can take shares. So now see here, now understand some important term. If interest is payable and it is mandatory, can I say if it's mandatory, it's financial liability. It is a characteristics of financial liability. If it is at the discretion of the company, then it is a equity because whenever the company wants, they will pay. If not, no need. So it is a character of equity. If borrowing is redeemable, if it is compulsory to redeem, then financial liability. If it is irredeemable or perpetual, equity. If borrowing is convertible in variable number of shares, if the borrowing which you have taken is converted in variable number of shares, then it will be financial liability. Even though the conversion is in what? Equity shares. If it's variable number, financial liability. If it's fixed number of shares and it is compulsory to convert in fixed number of shares, if it is compulsory to convert in fixed number of shares, it will be equity. If it is convertible at the option of the issuer or the holder, in that case, what we say, if it is at the issuer, then it is a, that is the entity equity. If it is at the holder, then it is compound financial instrument. So now how, what is compound financial instrument? Understand, compound financial instrument means characteristics of equity is also there, liability is also there. So the company should record both separately. Yesterday we have done for IFRS to share based payment, same thing. So what is the first step? Identify financial liability and equity. So in step 2, what we do? We calculate the value of the liability. To calculate the value of equity, what do we do? Whatever is the amount we received minus the value of the liability, we get this one. So step 4 is unwinding. By chance, this question will not come in your exam. If you're very lucky, if a question comes, so write down that first we have to record it separately, financial liability and equity. So financial liability is measured at amortization cost method. Equity is measured at cost. Equity is measured at cost. Now see here for transaction cost. In case of transaction cost in compound financial instrument, what should we do? Allocate transaction cost to financial liability and equity compound in the ratio of the amount calculated. That means I say today the value was 3 lakhs. My financial instrument came to 2,70,000. Equity came to 30,000. Now the transaction cost is 10,000. This transaction cost I will allocate to equity and liability based on the value which I've got. 2,70,000 and 30,000. So I get 9,000 and the remaining will become 1,000. So what will you do? This 9,000 I will reduce from the amortization cost method, because you know financial liability, what we do, we reduce the value, and for equity also we will reduce the value. Then chalo next one. discount rate for interest calculation, same rate which is used to calculate financial liability. Now, when you calculate financial liability, when you discount, you should use the rate in the market for the same bond without conversion option. Without conversion option. So let us take an example. A company issues 4% convertible bond at nominal value of 50,000. Interest payable annually in arrears. Interest is payable annually in arrears. Each thousand bond $1,000 value of the bond is convertible at any time up to the maturity in 4,000 equity shares, or the company can take the cash also. The market rate applicable to non-convertible bond is 6%. To calculate the cash flow, you will use 4%, but to discount, we will use 6%. Understand this. So what will I say? See, 4%. I have calculated the cash flow. I will take the last at the end of the third year. I'll take the principal amount also, so that I get the value of liability. This we do, we get your financial liability 47340. Then equity will be how much? 50,000 minus 47340. So 2660. So what is the entry? Debit bank, credit financial liability, credit equity. So in amortization table, what we do, we record the fair value, and normally we amortize and do the calculation. The value of the liability comes to 50,000 at the year end. In so what we record, finance cost, you record each and every year. But if I say now, what will happen to this one? Your equity, will the value of the equity change? The value of the equity option will never change. It will remain same at the end of 3. For non-current liability, it will be this, and at the end of third year, it will be current liability, because the company have to pay within 1 year based on the data which is provided in the question. Now at the end of third year, what will happen? Now either the entity will come and take cash, or they will say that we need shares. If the company is redeeming cash, in that case, we reduce the financial liability, we give what? The equity value to, we reduce our financial liability, we give them cash. On the other way, what should we do? Whatever is the balance in equity, we will transfer that to retain earnings. We will transfer that to retain earnings. If the company is saying that we need equity shares, and equity shares also, the face value is $1. Now, what is the value of the bonds? Can I say 50,000? Now, for each $1,000 of bond, how many shares we are receiving? 400 shares. So can I say we will do this, and we will get the number of bonds into 400? We get total number of shares as 20,000. Then what we do? The company first will do what? They will reduce the financial liability, and they will increase the value of the they will remove the value of the equity also. They will remove the value of the equity by 2660, and they will record share capital and share premium. Share capital will always be recorded face value, and share premium at the remaining will be the share premium. So I hope everyone, this is clear. The compound instrument treatment is clear to everyone. So with this, we have completed the basic, the calculation, and now coming to some small topics which are frequently tested in your, what we say, SBR, de-recognition of financial instrument. Now, financial asset, when will you de-recognize a financial asset? Can I say I will de-recognize a financial asset if I do not have any contractual right to receive any payment, or financial asset has been sold and substantially all the risk and rewards have been transferred? If the risk and rewards are transferred, then we will de-recognize it. So whenever a question comes, write down this. In case of de-recognition, get 1 marks. Accounting treatment. Now, accounting treatment depends here now. The difference between the carrying amount of the asset and the amount received should be recorded in P&L. Operating or investing category of SOPL, depending on the nature of the financial asset. Most of the time it will go to investing category only. But if you're selling your receivable also, it could be, today you have a receivable, you need money, you're selling your receivable. In that case, it will go to operating category. So see, there are two things: factoring, without recourse, with recourse. So what does without recourse and with recourse mean? See, A limited, R limited is there. R limited have a receivable of $10,000. They need money today. So if they need money, they will go to a person, etc. This B limited will be ready. The B limited will say what? Okay, we'll take your receipt, but today we will give you 9,500. So the 500 is an earning for B limited. So now with recourse and without recourse means what? Understand here. In case of with recourse, that means if I'm selling my receivable to you today, and if you will not receive the money from that customer or the third party, you can come back to me and ask the remaining amount. In that case, we say with recourse, that means you can come back and ask. In that case, it's not a sale of the transaction, that means I'm not transferring the risk and rewards to you, I'm still carrying the risk and rewards on my head. In that case, we say what? The factoring fees will be low. What should we do? Do not de-recognize. Whenever a question, the second marks. Write down this point, you'll get one more marks. And write down the amount also. It's not that you'll just write down the sentence. Do not de-recognize the asset. Instead, record the amount received as a financial liability. So record finance cost at each reporting date. So A has a receivable of 20,000 and has received 19,000 from the factor in which the risk and rewards are not transferred. If the risk and rewards are not transferred, we record it as a loan. We will not de-recognize the asset. But if I say without recourse means that you can't come and ask me the remaining amount. In this case, it will be a genuine sale. That means risk and rewards are transferred. In this case, your factoring fees will be high because he is taking the risk. The factor de-recognize the financial asset. Difference will go to P&L. Now see example. A has a receivable of 2,000 and has received 8,000 from the factor in which risk and rewards are transferred. So what we say, 18,000 we have received. I remove my receivable of 20,000 and the remaining 2,000 will go to P&L as an expense. As an expense. This is not credit here, it's debit, sorry. It's debit here. It will go as it will be as an expense. I hope everyone have understood this part. With this, the derecognition of financial asset is clear to everyone. Now coming to the derecognition of financial liability. Now, when will you derecognize a financial liability? A simple financial liability will be derecognized when there is no obligation or the obligation has been expired or cancelled. Accounting treatment, whatever is the carrying amount and minus the amount paid will be recorded in P&L. Either you'll have a gain or either you'll have a loss. If today your payable is 10,000 but you're paying 9,000, that means it's your income. If your payable is 10,000, you're paying 12,000, it's a loss to you. So in that case, it will be recorded in operating or financing category. Above it was operating or investing category. Here, operating or financing category. I hope the derecognition for financial asset and financial liability is clear to everyone. Now coming to the frequent topic which is repeated in your SBR, offsetting of financial assets and liabilities. Very important, whenever you get a question regarding offsetting, please write down this, you'll have 2 marks. In most of the cases I've seen, if you write down these technical words, you will get 2 marks straightforward. So see here now, financial assets and liabilities may only be offset in very limited circumstances. We have covered in IFRS 18 also in our regular classes, as well as in IAS 1 also we had offsetting. Can you offset any asset and liability? Yes, if any IAS or IFRS is specifying. If any IAS and IFRS is specifying, you can do this. If you want to refer the IFRS 18, it's uploaded on the Super Infinity channel, the lecture number 1 where we have discussed IFRS 18 in detail there. Now, financial assets and liabilities may only be offset in very limited circumstances. So, what are the conditions? You know, has a legally enforceable right to set off the amount. It should be legally enforceable. That means the parties should. It should be legally enforceable. That means it should be legally possible, and they should have an agreement with them. Okay, we will do offsetting. They'll mention in the contract. Okay, that we can do offsetting, and intends either to settle on a net basis. That means today I say that I have a payable from you of 1,000, 10,000, and I have to pay you 10,000, and I have a receivable of 8,000. Can I record in my books directly 2,000 of payable? Yes. When legally enforceable right via both the parties have agreed and the intends either to settle on net basis. That means what will I say? Instead you paying me 8,000, I paying you 10,000, I will directly give you 2,000. This means intention is there. Or it is or here. This is the first condition, this is second. In second condition, you have option A, you have option B. Or to realize the asset and settle the liability simultaneously. That means what? You give me 8,000 on the spot, I will give you back 10,000. You give me 8,000 on the spot, or within 1 or 2 hours, I will give you back 10,000. This timing difference is not determined by IAS and IFRS. It just mentioned that the settlement should happen simultaneously. Simultaneously means basically today only. Today you give me 8,000, within 1 or 2 hours, I'll again transfer you 10,000. In that case, if we have this principle, okay, we are doing this, we are practicing this, we are following this in the past we can record or we can offset and record the financial assets and liabilities from a party. That means there should be a liability and there should be a financial asset. Then only we can offset. It should be with one party. It should not be with some other party. Understand that? I hope the offsetting principle is clear to everyone. The last topic, treasury shares. It can come in your exam. I have not seen for 1 or 2 marks. Treasury shares means what? Entity may reacquire its own shares. Sometimes what will happen? The entity will reacquire its shares. In the market, the shares are listed. They will repurchase it. When they repurchase it, buyback. Yes, you can say buyback. When the company will repurchase them buyback, what will the company do? Either the company will cancel them or either the company will keep them for reissue. If the company mentions that we will reissue in the future, then what should the company do? What should the company do if they reissue? Anyone? If the company will reissue, what they will do? No idea, sir. If I say cancel, see now, if the company is reissuing, then what will happen? The company will do what? The amount paid for the share is presented in the statement of financial position as a reduction from the equity. Whatever is the amount which we have paid and we have received the shares back, then what will the company do? The company will reduce the value of the treasury shares from the equity box. If I say I have today equity, share capital, share premium. So what will I do? I normally record my share capital. I normally record my share. Whatever is the repurchase of treasury shares, we will reduce it. We will reduce. In case of if the company is saying that we will reissue them in future. But if the company is saying that we will cancel the shares, if the company is saying that they will cancel the shares, then there will be a gain or loss. That gain or loss will be recognized in retained earnings. It will not go to profit and loss. It will go to retained earnings. It will go to retained earnings. So with this, the treasury shares is also complete. So with this, the basic part, the first part of your financial instruments we have completed. Now, what is the second part? The second part is the important part, that is for SBI. Impairment and derivatives and hedging and small topics. So let us start with the topic now. I hope everyone can see the screen now. Impairment of financial asset. If you remember the impairment IAS 36, IAS 36 talks about impairment. In that chapter, in that standard, you will never cover this impairment of financial asset because it is covered in IFRS 9. You will not cover impairment of inventory also. There also, it's outside the scope. Yes, in your IAS 36, you will not do impairment for inventory also. Why? It is taken care in IAS 2. Now see here now. Impairment for financial. Impairment means what? Reduction in the value of the asset. Normally in your class 11th and 12th, and you would have covered in your FR also. Debit, we record it as a loss. Debit, we record it as a loss. It's a loss for you because the value of the expense is decreasing. You reduce the value of the asset and etc. You would have come across this term of provision for doubtful debt, loss allowance, etc. Now what we'll be saying here? We will be saying the term as loss allowance here. Loss allowance. So now see, scope of impairment. Now understand. Entity shall recognize a loss allowance for expected credit losses on the following. So expected credit loss means what? When what does the term credit loss means? Credit loss means the risk whether the to have sold goods to you. I have a receivable and you're not paying me. Credit risk means the risk of non-payment. And it should be recorded on the expected. Expected means you have to consider probability here because you will not be knowing. You are doing estimate. It's an estimate. Understand that. So now after that, so following financial asset, debt instrument, amortization cost method, financial asset at debt instrument, fair value through OCA, your lease receivable. These are the some of the examples which I have written here now. Now, will you apply impairment on financial liability? Never betting. You will never apply. Only on financial asset. And now see, note, financial asset at fair value through P&L. Both equity and debt instrument. Both equity and debt instrument. Will you apply Impairment? No, because already the fair value will consider the impairment loss. You will not apply. Financial asset at fair value through OCA, that is equity instrument, not required to be tested for impairment. For this also you learn. Especially I'm mentioning for what? Financial asset under fair value through P&L, debt and equity instrument, both no impairment. Financial asset, which category? Equity category. You will not record it. Directly the difference will be taken to OCA. For debt instrument under fair value through OCA, debt instrument under amortization cost, we have to consider it. And lease receivable, you will have your trade receivable, etc. If you remember yesterday I mentioned for the lesser, it's a lease receivable. It will be treated as per what? It will be treated as per your this one, impairment. So now see, recognition of credit losses. How should you recognize? On initial recognition of financial asset and at each subsequent reporting date, a loss allowance for expected credit loss must be recognized. That means at the initial date also we have to recognize. Today, if I have a financial asset, initially I should record a loss allowance. We'll see what are the cases. And then at each reporting date also we have to record the loss allowance. So see here now. Credit loss. What does the term credit loss mean, sir? Credit loss basically means today I say that I have to receive 10,000 from you. But I believe that you will pay me 10,000 and at the year end you believe you pay me 5,000. So can I say here so there is no loss, here also there is no loss. Can I say I have a 5,000 loss here? This 5,000 you will take the present value. This present value will be known as my credit loss. Credit loss is what? Credit loss is the present value of the difference between the contractual cash flow. My contractual cash flow is how much? 10,000, 10,000, 10,000. And the cash flow that the entity expects to receive discounted at the original effective interest rate. So the entity is saying that we will receive 10,000, 10,000, 10,000, but at the year end, at the end of the third year, they are saying that we will not receive 10,000, we'll only receive 5,000. So whatever is the difference, that 5,000 will be discounted and that will be your credit loss. I hope this is clear to everyone. I am going slowly only because it's a very important topic. For derivative, etc. also, I'll go slowly. Then expected credit loss. Expected credit loss means you'll apply the probability. You'll apply the probability. The weighted average of credit loss with the respective risk of the default occurring as a weight. That means this 5,000 you mentioned. Okay, what is the probability of this? You mentioned the 5,000. Is it for sure that you will not receive 5,000? It's an estimate. So what is the probability of this 5,000? You'll apply it. In your exam, it will be a straightforward question. It will not be so detailed. Lifetime expected credit loss. So now what does lifetime expected credit loss means? Expected credit loss that results from all possible default events over the expected life of the financial instrument till the maturity. Whatever is your lifetime loss, consider it. Once you calculate the value of the losses which will happen uh, throughout the asset, that will be known as what? Lifetime loss. But 12 months expected credit loss is what, sir? The portion of lifetime expected credit loss that results from default events on a financial instrument that are possible within 12 months. That means what is the loss in the coming 12 months? If it's a lifetime loss, that means what? What is the loss for the term of the asset? If you have invested in a bond today, if I say you have invested in a bond, it's a financial asset to you. The bond has a life or the term is for 5 years. That means for the 5 years, what is the total loss which you will have on that bond is known as what? Lifetime. Yeah, lifetime of the asset also you can say. But here you can't say lifetime of the asset because this asset is not a PP, etc. We can't say this, but you can say the period, etc. XYZ. Koi nahi. Whichever way you say, it's okay. See now, how will you calculate 12 months expected credit loss? I'm doing the basic. We'll come to whether should we use lifetime expected loss, whether should we use 12 months expected loss. We'll come to that. Calculated by multiplying the probability of default in the next 12 months, the present value of the lifetime expected loss that would result from the default. That means to calculate 12 months expected loss, what we do? We take the overall loss, we take the lifetime loss, and you'll apply the next 12 months what is the loss. You will take that amount. So this is the thing. So I hope this is clear to everyone. Initially, what will you do? On initial recognition of financial asset at each subsequent reporting date, a loss allowance for expected credit loss must be recognized. So now see here now. Now when coming to this one, at initial date you will record what? Every time at initial date, on initial recognition, you will record a 12 months expected credit loss. What will you record? 12 months expected credit loss. At subsequent, at each reporting date, what should you do? At each subsequent reporting date, the loss allowance requires depends upon whether there has been a significant increase in the credit risk of that financial instrument. That means if the credit risk is increasing or not, you have to see that. If the credit risk is increasing, then you record 12 months expected credit loss. So now, sir, what is the term known as credit risk? When will you say the credit risk has increased? Credit risk will increase when management should assess whether there has been a significant increase in the credit risk at each reporting date. Now, what is the assumption here? It's an assumption. It is given as per IFRS 9. The assumption is what? Today, you have a receivable for 30 days. You have given a time period for 30 days. After this further 30 days are done, still you have not yet received the payment. Then this becomes a significant increase in your credit risk. See, credit risk on the financial asset has increased significantly since initial recognition when contractual payments are more than 30 days due. Past due means already 30 days are done. After that also you have not received. The credit risk will increase. It's a general assumption which is given in IFRS 9. But you have to see the question and decide what should be done. Now see here what should you do. Important part. This is the important for your exam. If I say credit risk has not significantly increased since recognition, then recognize 12 months ECL. So initially today I had an asset, I recorded 12 months ECL. Now I am at the reporting date. From this reporting date, the further 12 months ECL I have to calculate and record it. Your interest income will be recognized on gross amount. Here you will not record the interest income on net amount. Net amount means what? Whatever is your carrying amount, you will reduce the impairment loss. And on that impairment loss, once you reduce the impairment loss, you get your new carrying amount. On that new carrying amount, you'll apply the interest income. That is not done here. That is only done when the asset is credit impaired. Then second stage, credit risk has increased significantly, initial recognition, but do not have evidence, objective evidence of impairment. Credit risk has increased, but there is no objective evidence. There is no for sure evidence that this will happen. In that case, what we do? Recognize lifetime ECL. What is your total loss? And interest income will be recognized on gross amount. Interest income will be recognized on gross amount. But the third case is what? Credit impaired financial asset. That means the asset has been credit impaired. That means you know today for sure you will not receive the amount. See, when you record loss allowance is based on estimate whether you will receive or not. Credit impaired means for sure you know that you will not receive from this customer because he has shut down his business and he is not in India. Simple. In that case, what we do, objective evidence of impairment is there. Then what we do, recognize lifetime ECL. Interest income will be recognized on the net amount. Interest income will be recognized on the net amount for the future years, not for the current year, for the future years. So see, where should you record the lifetime loss? If it is at amortized cost method, if you have an impairment loss, record in investing category, debit impairment loss, credit financial asset. If it's at fair value through OCI for debt instrument, fall in fair value through. Now, whenever we calculate fair value through OCI, can I say automatically the impact will be taken to what? If I say today I have a debt instrument, I am following fair value through OCI. And the fair value I got a difference of 1000. Now my value is decreasing by 1000. My fair value is decreasing by 1000. In that case, the decrease could be because of two reasons. The first reason could be because of the fair value change. The second reason could be the credit loss, the credit risk which you have. So in this case, what we say, if I say the credit risk is 200, this 200 will be recorded in P&L, the remaining 800 will be recorded in OCI. This will be given in your exam question. Out of fair value through OCI, how much is the credit loss? How much is the fair value difference? So see here now. Fair value is recognized in P&L relating to credit losses. Remaining is recognized in OCI. So debit impairment loss, debit fair value through fair value loss, and credit financial assets. So you'll record a loss in OCI, you'll record a loss in P&L. Which category in P&L? Investing category. So measurement, when you measure the value, what should you consider, sir? You should consider probability. It should be unbiased. It should consider time value of money. You should do the discounting, and it should be based on reasonable and supportable assumption, as well as the you should consider the current condition as well as the future condition. It's not that only you'll consider the current, future conditions also you have to consider whether you will receive or not the payment. With this, the stage 1, stage 2, and stage 3 is done. I hope it is clear to everyone. Now, when will you say that, sir, my asset is credit impact? When will you say that for sure you know that the asset is credit impact? If the asset is credit impact, lifetime loss we record, and the income will be based on what? The income will be based on the net amount, not on the gross amount. So here now see, significant financial difficulties or the issuer or the borrower. That is financial difficulties to the person for whom you have given the amount. Breach of the contract, such as a default or past due events. That means they have default some payment. This is also an hint for credit impact. Then lender of the borrower. These all indications will be given in your question, and then you have to identify, okay, whether the asset has been credit impaired or not. Lender of the borrower have granted to the borrower a concession that the lender would not otherwise consider. That means some concession we have given, that okay, we have reduced the amount to you, etc. You only have to pay this much. That is also an hint or indicator for credit impairment. Then it is becoming probable that the borrower will enter bankruptcy or other financial reorganization. The person or the entity to whom we have given will enter into what? Some reorganization or is into bankruptcy, etc. These also are the indicator for credit impact. Then disappearance of an active market for the financial asset because of financial difficulties. That means it becomes a financial asset for you. In that case, what will you do? In that case, if the financial asset which was listed, it's not that it has not been listed in the market, now they have de-recognized, the government came with a rule and regulation saying that you have to delist it. In that case, that is also a reason, or we can say assets are credit impact. Understood everyone? Yes or no? Okay, chalo then. Now coming to trade receivable, contract asset, and lease receivable. If you remember in IAS 36, we have mentioned that for contract asset also, we will not do impairment there. Impairment will be done here only in financial instrument. Contract asset means what? You have receivable. You have done more work, but you have not yet received the payment. So a simplified approach is permitted for trade receivable, contract asset, and lease receivable. For contract asset, lease receivable. So what is the simple approach? Because this lease receivable, trade receivable will most of the time be for less than 12 months. Trade receivable will be for less than 12 months. So trade receivable or contract asset that do not have a significant financing component under IFRS 15, the loss allowance is measured at the lifetime expected credit loss from initial recognition only. That means if you have a trade receivable, if you have a contract asset, and that does not have financing component, that means the time period is not more than 12 months. In that case, we do what? We follow lifetime expected credit loss. We will not follow 12 months expected loss. We'll follow lifetime expected loss. A provision matrix is a practical method of calculating ECL on a trade receivable. We have done this in the class. I'll take 2 examples for this also, no issues. Then coming to the next topic of purchase or originated credit impaired asset. A very important topic. You have one question in your past paper also. We have done this. It was for 8 marks, if you remember. So financial asset may already be credit impaired. That means what? Credit impaired basically means what? Today, what is happening? I am a bank. I have loans. I have to receive from the customer. I have given loan. That means in my book, it's financial asset. I know that these customers will not pay me back. So now I sell these loans to you. That means you are purchasing what? You are purchasing financial asset. But these financial assets are what? Credit impact today only. That means the bank also knows that we will not receive the amount, but still you are purchasing them. But you say that, sir, we are purchasing it, but we know we have the way to get the money back. So in that case, what will you do as a company? You will say these assets are what? Credit impaired asset. In that case, what? Initially measured at the transaction price without an allocation for ECL. Without any allocation. Initially, you will record at the value which you pay. If I say I had to receive from the customer $10,000, but I know that the customer will not pay, so my asset is impaired. So I say that I will sell this asset to you at 8,000. No, not 8,000, 5,000. Now you are paying 5,000. So in your books, you will record the asset at 5,000 only. But that 5,000 which you are paying, you say that, sir, I know the way I can get the money back from the customer. I'll get either 6,000 or 7,000. I know. So in that case, in your books, you will record financial asset at 5,000. Interest income is calculated. Interest income is calculated by applying the credit adjusted effective rate to the amortized cost of the asset. So how will you record the interest income? You will record the interest income on what basis? You will record the interest income based on not on EIR rate. It is based on credit adjusted effective rate. This will be given in the question. So write down this point. If you write down this 1 marks, 1 marks and 1 mark. If the question comes for 6 to 8 marks. Then subsequent changes from initial ECL are recognized as a separate allowance in profit and loss as an impairment gain or loss. Once you purchase today 5,000 value of asset, you mentioned, sir, that I have the capacity to recover the 6,500 from the customer. But it became ulta. Now what happened? This 5,000 which you purchased, now you have a loss now. You are not able to recover. Now you only will be able to get 4,000 from that customer. So 1,000 is a loss for you. You will record this into P&L. But if I say from this 5,000, you are getting 6,500. So the 1,500 will be your income now, will be your income. So the values will be given. So consider it and write it. It's a too complex topic, but remember the basic. What is the basic? Initially, whatever is the amount you have given, that will be recorded. You will not record any loss here. Interest income over the period will be recorded at what value? Will be recorded at amortized cost. Subsequent changes from initial ECL are recognized as a separate allowance in P&L as a impairment income or loss. What in the question, what will happen? No, in the question, they will give you the discounted value. They will give what the cash flows they'll give in future. What is the cash flow? You have to discount that and record the value, and you have to again unwind it. If you do the unwinding interest income and whatever is the closing balance, you should compare with the value, how much the value will receive. That difference will be gain or loss in the books. So please do, a question is there regarding this in your exam kit. The name I forgot. One question is there, so please do it. Then impairment reversal. So can there be impairment reversal? Yes. We have seen that there is an impairment reversal in your IAS 36 also. Here also there can be what? Impairment reversal. Impairment reversal can happen here also. In that case, what we will do if there is an impairment reversal? If an entity has measured the loss allowance at an amount equal to lifetime expected loss in the previous reporting period, that means previous year we recorded lifetime expected loss. But now we are saying that, okay, now the lifetime expected loss which we have recorded will not be considered. Now it is only 12 months expected loss. But determine that the conditions are no longer met, it should revert to measuring the loss allowance at a amount equal to 12 months. That means first you have recorded lifetime loss, now you are recording 12 months loss. In that case, there is a reversal because the lifetime loss will be more. The 12 months loss will be less. Understand that. Gain or loss on remeasurement of loss allowance is recognized in profit and loss in the same category. Whenever you had a loss allowance, you normally record in investing category. If it is regarding trade receivable, you record in operating category. So whenever there is a receivable, if the receivable is regarding some bond, etc., you record in investing category. If the reversal is regarding your trade receivable, you record in operating category. So I hope everyone have understood this impairment case. I hope the case of impairment is clear to everyone. There is no such doubts. Now coming to the next part, the modification of financial liability, a very important topic again. You have in 2022 or 23 paper, in the first question, you have this question, your consolidation question. In that you had for 8 marks or 6 to 8 marks this calculation. So now modification of liability. So modified terms of borrowing. If substantially differ from the original terms, if there is a huge difference, then you will follow what? Extinguishment accounting. That means you will remove it. Whatever is the financial liability, you remove it and you recognize new liability. Not substantially differ from original terms, follow modification accounting. Now, sir, how we will get to know whether it's substantially different or not? You have to do a calculation. You have to calculate the percentage. If this percentage is more than 10%, you say it is substantially different. How should you do the calculation? See now. You should take the present value of the cash flow under the modified terms, including any fees discounted using the original EI rate, less present value of the remaining cash flow under original arrangement. That is the carrying amount of the financial liability. So you'll have a financial liability. Now, financial liability, you'll have some carrying amount in the books. This carrying amount you'll compare with what? This carrying amount you'll compare with the new inflow, which will be getting at what? Which will be discounted as using the original discount rate. Original discount rate. Now, then you will divide this with what? You will divide this with the carrying amount. The present value of the remaining cash flow under original arrangement, carrying amount of financial liability and modification rate. You will do this. You will say carrying amount, you will say the new value, whatever is the new value you will receive, because the if the term is modified, that means instead of receiving every year 10,000, you will receive 12,000 or 9,000. If you modify, whatever is the cash flow in future, you will discount it. Once you discount it, you will compare and check whether this is more than 10% or not. If I say my carrying amount is 10,000, but the modification is done in the terms, loan terms, I say that you will only receive, you will get 20,000 now. You'll get how much? 14,000. So now what is the difference here? 4,000. This 4,000 you will compare with 10,000 again. Can I say this is 40%? It's more than 10%. It's more than 10%. If it's more than 10%, that means what? Terms are substantially different when modification percentage is 10% or more. If it is 10% or more, then we say it's that. You follow what? Extinguishment accounting. So what you do, de-recognize the whatever liability you have. What will I do? I will de-recognize this 10,000 and I will record the new liability. And that new liability I will record at fair value. And new liability is recognized at fair value. Whatever is the fees which we have paid will go to P&L. Whatever is the fees which we have paid will go to P&L. The fair value will be given in the question. So any difference will be recognized in P&L under financing category. So my financial liability, the carrying amount of the asset is going out. Then I record new financial liability at fair value. Then I say bank account, any fees is paid. Then debit, credit, whichever side the balance is there will be your gain or loss. If it's on the debit side, loss. If it's on the credit side, it's a gain, where it will be recorded in financing category. This is when the percentage which you have calculated is 10% or more. You will follow what? Extinguishment accounting. You can do this, or you can do questions which are there in your one of the publication books. In one of the publication which you normally follow, questions are there. Two questions are there. Please do, so that you'll have a better understanding. If terms are not substantially different, that means the modification percentage is less than 10%. That means the modification is less than 10%. In that case, what we do? In that case, we follow modification accounting. Modification accounting means you will not de-recognize the original liability. The original liability will be there. Do not de-recognize the original liability. Original liability should be modified. That means restate to the present value. That means I take my carrying amount is 10,000 of the liability and it should be modified. I say the new value is 11, it's 10,500. In that case, I will increase my liability by 500. Fees paid, reduce the financial liability. Above what we have done, above in case of extinguishment accounting, whatever is the fees paid will go directly to P&L. Here what will happen, the fees paid will reduce the value of liability. So any difference will be recognized in P&L under financing category. So what we do, debit, I'll increase my financial liability by 500. It's a loss to me in P&L. And what will I do? The fees which I pay, I will reduce the financial liability value. If I say I paid 100 rupees fees, I will reduce this from the financial liability value. So with this, the modification accounting is also done. Any doubts to anyone in the modification? In your exam, I have not seen the extinguishment accounting. I have seen questions regarding modification part. This has not been tested yet, and it will not be tested also 99.99%, but this can be tested, your modification part. That means you have to recognize the original liability and whatever is the difference, you have to increase it. So with this, Impairment we have completed. We have completed the modification part. Now coming to the last part. That is what derivatives. Accounting for derivatives. A very important topic in your pre-September mock also you had a question regarding hedge accounting. A very simple things, you have to only remember 5 to 6 points, it is done. So now what is a derivative? Can I say derivative is a contract which derive its value from underlying asset? Derivative will never have its own value like your future options. It will derive its value based on some underlying asset. If I say today we are doing a betting on whether Virat Kohli will hit a century or not, can I say in that case the betting which we are doing is based on some underlying asset? The underlying asset is what? The Virat Kohli skills, whether he'll play today good or not, whether he'll hit a century or not. Derivative will never have its own value. It will derive its value from an underlying asset. Then underlying assets can be what? Shares, index, currency, commodity, gold, silver. It could be anything. Now derivative is a financial instrument. Okay, sir. Derivative can be a financial instrument when the following three conditions are satisfied. The first condition is what? Its value changes on response to the change in the value of underlying asset. Yes or no? If the value of the underlying asset is changing, that means your derivative values also will change. If today I say that I have done a betting on Reliance share price, today Reliance share price is 2000 in the market. I mentioned that the value will go to 2200. That means today I've done a betting. That means now I say the value of the Reliance share price after 3 days has become 2030. Can I say this 30 is what, sir? This 30 is an increase for me. It's a gain for me. It's a financial asset for me because I am winning here. I am on a positive side. It's a favorable to me. Can I say if I do a contract with someone saying that it will increase, some other person will say it will decrease? For him, it will be a loss. For him, it will be a financial liability. For me, it will be a financial asset. So now this 30, how did you get that? So 30 is my increase. Can I say this was based on the Reliance share price going up or down? It requires no or very low investment. Whenever we do any betting, we never pay any amount. We just say, okay, I've done. Or some low amount will be paid. In case of futures and in case of options. In case of options, we pay a small amount of premium. Understand that? Now the examples of derivative contract are forward contract, futures, options, and swaps. You need not go into detail. You are just doing the accounting treatment. So understand that now. Note, a contract to buy or sell a non-financial asset like PP, etc. is only derivative. This also has been tested for 3 to 4 times. If a company has a contract to buy a non-financial item, can this be a derivative? Yes. It can be a derivative if the contract is settled net in cash. That means the company will not purchase the asset. Today, I have done a contract with a person saying that I will purchase a machinery at this value. But ultimately, I will not purchase the machine. I will do the settlement net in cash. If the value of the machinery is increasing in the market, whatever is the difference amount, I will get that. So it can be settled in net in cash. So write down this point whenever you get any question in your exam regarding the derivative, regarding non-financial items, you will get marks, 1 or 2 marks depending on the marking scheme. The contract was not entered into for the purpose of receipt or the delivery of the item. That means the company's intention is not that to take the delivery. For what reason? For the using this asset for the entity's operating purpose. For using this for a the entity will use in the day-to-day activity. It's not the agenda or the criteria for the company. The company will never say that we have entered into the contract, we'll purchase this asset and we will use for our business. They'll say that it's not our main aim. The main aim is to what? To do betting, to do gambling and get the return. So when will you say that the settlement is done net in cash? Contract permit either party to settlement net in cash. Either party has the right to do settlement in cash. Entity has a practice of settling similar contract. In the past, the entity has done the same thing. They enter into a contract, they never purchase the item. They do the settlement net in cash. That means the company's aim is to do betting and just to earn the profit. Then non-financial items is readily convertible into cash. If the non-financial asset is readily convertible into cash, we say that the settlement is done in net in cash. Then entity for similar contract has practice of taking delivery of the items and then quickly selling. Even though what can happen, the company can take the machine immediately, they'll sell to someone else. This is also what a settlement net in cash on. That means the company is not using this for their business purpose. In that case, we can say a non-financial item can also be a derivative contract. If a contract is not a derivative, then it is simple a executory contract. Executory contract means where the performance has been done by the entity also and the party has paid the payment, or if the entity has not performed any work and the customer has not made any payment. I hope this is clear to everyone. Now, what is the accounting? See, a simple thing you have to remember. If it's potentially favorable, what will you do? If it's potentially favorable, you record a derivative financial asset. If it's potentially unfavorable, you record what? Derivative financial liability. Now, whenever on initial recognition, generally the value will be zero. If I say today I have done a betting on Reliance share price, I say that the value is 2000. I have done a betting on the upside. The share price will go up. So now after 1 month, let's say after 1 month the value is 2100. So can I say what is this now? It's a debit financial asset and a P&L gain for me of 100, because I've done a betting. I did not pay anything. I've done a betting with you saying that if Reliance share price will go up, whatever is the amount that will go up, you will pay me. If it will go down, I will pay you. Simple. So it's going up, so it becomes an asset for me. For you, it will become a liability because you have to pay me. Then after that, it becomes 2200. So can I say what is the ultimate increase? Yes, sir, 200. Out of this 200, we have already recorded. So again, I'll record a financial asset of 100 and I'll say P&L. After this, I say that it becomes what? It becomes 1100 value. That means what? I will reduce my value of the financial asset and I'll record in P&L as a loss. I will reduce the income which I've recorded. Now, this, when should we do this? So at what date we should consider? At each reporting date. At what? Each reporting date. That is your balance sheet date. At your balance sheet date, you have to do this. So now initial recognition, if any payment is done, generally I mentioned initial value will be 0. I mentioned that to do this betting, I paid 10 rupees to you. This 10 rupees will be a financial asset for me. So debit financial asset of 10 and credit PL of 10. And then the value becomes 2100. Already I've recorded 10 rupees gain. So my next gain is how much? 90, and I'll record in PL as a 90. See here now. Potential favorable, you have to record if some premium is paid in case of options. In your exam, directly the value will be given if the question is there. Now, subsequent recognition, that is at fair value. I mentioned derivative accounting will follow fair value through P&L only. Understand that. So, gain or loss. If it's a gain, you will record in financing category. And when will you record this in financing category? If it involves raising of finance. If the derivative instrument which I've done is done for raising some finance in the business, I have a risk, I have to take a loan, etc. On that basis, I've done some derivative contract. It will go to financing category. But normally, where it will be recorded? Normally, it will be recorded in operating category. If the derivative or the your taken futures option, it is regarding the raising of finance, you believe that in future the interest rate will increase, etc. xyz, in that case it will go to financing category. If not, it will go to operating category. Now see, what are the journal entries? Generally, no entry, fair value 0. If cost of premium is paid, you record this as an asset. At reporting date, at your balance sheet date, if it's favorable, the company will record debit financial asset, credit gain. And if it's unfavorable, they will record a loss and they will record a financial liability. When will they record a financial liability? First, they have to remove the financial asset. Then they have to record it as a financial liability. Now, when the settlement date will come, on settlement date, what will happen? Either the customer will purchase the underlying asset or they will do net settlement. In net settlement, what will happen? You will have a financial asset. If there is a net settlement, you have a financial asset, you will receive that amount. You will receive debit bank. I mentioned that ultimately at the end of second month, the value of the Reliance share price is 2200. That means in my books, I have a derivative financial asset of 200. That means I will do the settlement net in cash. That means you will pay me 200 directly. So you pay me 200, I record bank account 200, debit, credit, I remove my financial asset. This is when the derivative is settled net in cash. So which vice versa, which loss, that means I will have to pay you. I will have to pay you. This is in which case, this is a case when the settlement is done in net in cash. I have not seen question where the examiner is asking any physical settlement. If there is a physical settlement, this will not be tested. I have not seen such questions, so no need. Then coming to the last topic, hedge accounting, a very important topic. This was tested in your exam. Now some key principle. What is hedge accounting? Hedge accounting is a method of managing risk by designating one or more hedging instrument so that their change in fair value is offset in the whole or in part by change in the fair value or cash flow of a hedge item. So normally what? No, let's take an example of IPL. Each match for Chennai and RCB. So what will I do? I'll do a betting saying that with one party I will do a betting saying that Chennai will win. On the other side, I will do a betting with some person saying that RCB will win. Can I say I'm hedging my risk? If there is a loss, I have done 1 lakh rupees betting on Chennai, that Chennai will win. On the other side, I have done a betting saying that if RCB will win, 80,000. So on the both these sides I have done. So my ultimate loss will be 20,000 on ultimate. So this is known as hedging to reduce your risk. Either hedging can eliminate your risk fully or it can reduce your risk. So that what will happen, on one side there will be a gain, on the other side there will be a loss. On one side there is a gain, on the other side there is a loss. This is known as what? Hedge effectiveness. A relationship should be there. Hedge accounting is a choice. Okay, hedge accounting is not compulsory, it is a choice. Understand? If hedge accounting is not used, then the hedge item and hedge instrument are accounted for in the same manner as other financial asset and financial liability. Hedge item means what? Today I say that I have an inventory of 100. I believe that in the coming years or in the coming months, I think that the value of the inventory will come down to 50. I think I think that the value of the inventory will come down. So today what will I do? Today only I will do a contract with some person to sell this inventory at what? To sell this inventory at $120. That means what is happening? One side I have a risk. On the other side, I say that I have a gain here now. So what we do today only, we say that I do a contract with some party to sell this inventory. If I say I do a contract with some party, I will sell this at 100 only. I will sell this at 100 only. And I believe on the other side that the value will come down. So here if I sell this, no such issues. And this 50, I have a risk. So when I do this contract to sell this at 100, when I do that contract, either it could be futures, either it could be options, either it could be swaps, etc. I'll have a gain or loss. I'll have a gain or loss. So here, see now, your hedge accounting is very complicated, but understand the basic here now. Now, what is hedge item? Hedge item means what? An item that is exposed to the risk of change in fair value or change in future cash flow and designated as being a hedged. It can be what? Hedge item can be what? A recognized asset or liability, like your inventory, your bonds, etc. Unrecognized firm commitment. The firm has done any firm commitment, but they have not yet recognized it. It's a highly probable forecast transaction or a net investment in foreign operation. This will not be tested for you. Only these three things will be there. So either it can be what's a recognized asset or liability. Today I have a asset that either it could be a financial asset, either it could be an inventory. I have a risk saying that what? The value of the inventory will come down. Unrecognized firm commitment. Highly probable forecast transaction. These are the example for hedge item. For hedge instrument, what is the example? For hedge instrument is a designated derivative. Hedge instrument is a derivative or a non-derivative financial asset or financial liability whose fair value or cash flow are expected to offset the changes in the fair value or future cash flow of the hedge item. In our regular classes, we have taken a very good example and we have discussed this for 40 minutes. But now I can't discuss in detail. So remember, hedge item means the item on which the company has a risk. So the company will do what? The company will enter into a contract, and so that contract will be what? A derivative. Most of the time it will be a derivative. So that if I have a loss here, there I'll have a gain. So now see the types of hedge accounting. Fair value hedge, that means there is a risk of decrease in the value of the asset, like your inventory. Hedge the change in the value of the recognized asset or liability, or hedge an unrecognized firm commitment. So if it is regarding recognized asset and unrecognized firm commitment, it will be what? A fair value hedge. It will be fair value hedge. Cash flow hedge will be what? Cash flow hedge means what? Hedge the exposure to variability in the future cash flow from a recognized asset or liability. That means there is a exposure towards the variability of the payment which you receive from any recognized asset or liability, or a highly probable forecast transaction. If in your exam, if the question will come, it will come from this fair value hedge or the second part here. In cash flow hedge, second part, a highly probable forecast transaction that could affect the profit and loss, because there is a transaction which you have to make in future and it is probable that you have to make, but in future the value of that will increase or decrease, so it is creating a risk to you. So that means your payment is also dependent on some future thing. So risk is that the company will enter into a contract. So what are the criteria for hedge accounting? If in the exam question comes, the questions will be direct, either from what is fair value hedge, what is cash flow hedge, and what are the criteria. The criteria is what? Hedging relationship should be there. That means only hedge item and hedge instrument should be eligible as per IFRS 9. Then at inception, there is a formal designation documentation. A documentation should be mentioned. Okay, we have entered into this contract because we have a risk for this. Documentation should be done. Hedging relationship meets all effectiveness requirement. That means hedging relationship should be there. On one side, it will increase, on the other side, it will decrease the value. So now, when will you say the hedging relationship meets all effectiveness criteria? There is an economic relationship. That means value move in opposite direction. Once on one side you have a gain, on the other side you have a loss. The effect of credit risk does not dominate the value change. That means whenever an asset is there with you, there could be two types of risk. In future, the risk is there, as well as a credit risk can be there. That credit risk will not be considered under hedge accounting. It should not be there. Then the hedge ratio should be maintained. Hedge ratio means what? I mentioned, I'm doing a betting for 1 lakh rupees on one side. On the other side also, if I do the betting for RCB, I should also do for 1 lakh. If I do this for 90,000, can I say there is a risk? There is a risk here. See, when the company is entering into hedge accounting, the intention is not to make profit. The intention is only to reduce the risk. It's not an intention for the company to make profits. When they enter into hedge accounting or hedging, the intention is to safeguard or to reduce the risk. It's not the aim to make profits here. So hedge ratio should be equal. Now coming to the accounting, which is very important here. Accounting for fair value hedge, what will you do? At the reporting date, hedge instrument will be remeasured to fair value. They'll directly give you the value. Hedge instrument will be remeasured to fair value. Carrying amount of the hedge item will be adjusted for the change in fair value. That means hedge instrument, hedge item, both will be recorded at fair value. The gain or loss on the hedge instrument and gain or loss on the hedge item will be recognized in profit and loss. In most of the cases, it will be normally recorded in which category? P&L. It will not be recorded in OCI. Most of the cases, it will be recorded to P&L. Gain or loss on both hedging instrument and hedge item are usually presented in the same line item of the profit and loss that relates to the hedge item. Now, if I say inventory we record in operating category. For this inventory, you have done a hedge accounting. If you have a gain or loss, it will be recorded in operating category. Understand that. If it's regarding some bonds which you have recorded in investing category, then the gain or loss will go to investing category. Now see, in case if the hedge instrument is an equity instrument measured at fair value through OCI, then and hedge item gain or loss, as well as the hedge instrument, both gain or loss on hedge item as well as gain or loss on hedge instrument, both will be recorded in OCI. In which case, only if the equity instrument are under which model? Fair value through OCI. So in your exam, if you get this question regarding fair value hedge, so please write down these points. Even though your calculation will be wrong, you just have to compare the numbers. So today I say what? My value 0. My hedge accounting, I have a profit of 10,000. On the other side, I have a loss. So here I will record a gain, I will record a loss here. Simple. Accounting for cash flow hedge. So in case of accounting for cash flow hedge, what should we do? Hedging instrument. Hedging instrument will be remeasured at fair value at reporting date. Every time hedge accounting or derivative, it has add fair value through P&L. Whatever is the difference, you have to take to P&L. Now see here now. Here, normally you take where in case of hedge accounting, normally you take this to OCI. But now you have to decide here. There are two things we have to decide. The first thing is what here now? See, effective portion, ineffective portion. So now what does effective portion means? Understand. Effective portion means what? Portion of the gain or loss that is an effective hedge is recognized in OCI and accumulated in cash flow hedge. In case of what I mentioned, in case of cash flow hedge reserves, you normally record in OCI. You normally record in OCI. Whatever is the difference, you normally record in OCI. That means gain or loss on hedge instrument is equal or less to gain or loss on hedge item, it will be recorded in OCI. You have to compare the gain or loss. You have to compare the gain or loss on hedge item and you have to compare the gain or loss on hedge instrument. And then you have to decide what should be done here now. Now, change in the fair value of hedge instrument through OCI. If a hedge forecast results in a non-financial asset or financial liability, we have to see. So, is this now? Let me take an example so that this will be clear to everyone. So, today I say, let me take the example which you have done in the class only regarding your hedge accounting, the basic question which we have done. SBR hedge accounting notes. See here now. In cash flow hedge, if I say today the hedging instrument has a value of 8,500 or has a value of $10,000. This is a what? Hedging instrument. Now I say that this is regarding cash flow hedge accounting for cash flow. It's under fair value for cash. So I say that here now you have a fair value increase of 9,100. How much is the increase here now? 9,100. The increase here is how much? 9,100. Now what should we compare? We should compare the hedge item and the hedge instrument here now. Now what is the gain here now? The gain is how much here? 9,100. But how much is this? 8,500. So can I say this 8,500 here? The gain or loss on the hedge instrument is less or equal to the gain or loss on hedge item. On hedge item, what is the gain? On the hedge item, 9,000. But can I say the hedge instrument gain is less only? If it's less, totally it will be recorded in your OCI. It is your financial asset, uh, uh, derivative financial asset, and you will record into cash flow reserve, your OCI, saying that this is my reserve. If it is 10,000, can I say it is 10,000? That means the gain on the hedge instrument is more when compared to hedge item. So what we do here, the total gain is how much? If you see the total gain is 10,000. So you say, and what do you record? Out of this, whatever is the difference will be recorded in P&L. Whatever is the difference will be recorded in P&L. And the remaining where will we record? The remaining we will record in OCI. So now how much is the increase? 9,100. So 10,000 is the value of hedge instrument. For hedge item, how much is this? 9,100. So can I say hedge item value is less when compared to hedge instrument? So that means hedge instrument gain is more here. It is more. In that case, whatever is the amount which is more, you will record into P&L. So I say 900 will go to P&L and the remaining will go to OCI. If in the exam this will come for this entry only will come, not more than that. You have to compare the values. So any doubt still here? Ineffective portion, any ineffective portion, excess gain or loss on hedge instrument, excess gain or loss on hedge instrument is recognized in P&L. I mentioned here this principle also. Only excess is recognized in P&L. Category based on the hedge item. Which category? It will be based on the hedge item. Whether it's your inventory, whether it's your bond, etc. XYZ. So now see here, if the hedge, if the hedge item, if the hedge item is a non-financial asset or a non-financial liability, yes, then what will you do? And no, if the hedge you have done on a non-financial asset like a PPE, like a inventory, etc., in that case, what will happen? Remove the cash flow hedge reserve and adjust it. This OCI balance of 9,000 will be adjusted to the carrying amount of the asset or liability. If the hedge is relating to what? If the hedge is relating to a non-financial asset. If the hedge is not relating to a non-financial asset, it is relating to a financial asset like receivable, etc. All other cash flow hedge reserves, the cash flow reserve amount from OCI is reclassified to P&L in the same period that the hedged expected future cash flow affects the profit or loss. That means whatever is the OCI balance will be taken to P&L for financial asset and financial liability. For financial asset and financial liability. In case of non-financial asset and financial liability, it will be adjusted to the carrying amount of the assets and liability. Understand that. So what will I do here now? If I say this is regarding a asset, that asset is a financial asset, a non-financial asset. If it's a financial asset, I will reduce it. So I will debit OC and credit, I'll increase my value of the asset by this one. On the other hand, what will I do if it's a non-financial? Sorry, my bad. It is P&L here. If it's a non-financial asset, I will reduce the OCA, your OCE, and I'll take this to the financial asset. Not financial asset, will take to the carrying amount of the asset. You will adjust this. I hope everyone have understood this. You have to practice some basic questions so that if by chance, if it's a very bad day, you have a question, you can do this. So with this, I hope everyone have understood the hedge accounting. It's difficult, the financial instrument, the second part which we have done, it's difficult, I know that, but do some basic question. The examiner will ask you the basic part only. The examiner will never ask you complex part in the financial instrument. Yes, but I'll share these notes. So with this, we have completed financial instruments. We have completed what? Financial instrument. Now we have to do employee benefit. It will not take much time. We have to do IAS 12 also. It will not take much time. So let us take a 10 minutes break. Come back and do the remaining standards. So now the time is 10:57. Everyone be back by 11:07. Chalo, come back, everyone. Yes or no, if you're back, Sevi?
Yes, sir.
Yes, chalo then. Yeah, I know that financial instruments is little bit tricky, the derivative accounting, the impairment loss. But if in the exam the question will come, as you would have done your exam kit, you would have seen the basic questions only will come. In detail will not come. So remember the basic, write down, you will get marks. No issue. So the financial instruments we have completed. Now we will start with your employee benefit, EPS. Not EPS. IAS 19 we will start employee benefit.
So I had a question. Will analysis and interpretation of financial statements come? Because usually it's not seen much in all attempts.
The question will never come. I have not seen questions. If you want, you can just see the ratios. We have discussed some important ratios, and EPS also we have done in class. So that much you remember, it's enough. Not more than that. Very rare. If it comes also, analysis and interpretation should not be much issue for you.
Yes, sir. But just we should remember the ratios to be on the safe
Remember,
side.
yes.
Okay, sir.
Now, chalo, starting with IAS 19 employee benefit, another important standard for your SBR. It's a very important standard. Here you have to just remember 10 points which I say. Remember the standard is there. I'll not go into detail, but I'll explain the basic points. So see now, employee benefit. Now, employee benefit means what? Whenever the company gives any benefit to the employee, like salary, bonus, pension, gratuity, some medical insurance, a lot of things. How will the company do the accounting? This standard applies to all the employee benefit expense except employee share-based payment as per IFRS 2. Yes, we have discussed yesterday also. Whenever ESOP is given, the accounting treatment will cover under share-based payment, not in IAS 19. Then employee benefit. All forms of consideration given by entity in exchange for service rendered by employees or for the termination of employment. That means the employees will work for your company. You will give them some salary or some benefits, as well as when you terminate the employee, when you say that you have to leave the company now, so at that time the company will pay 1 month or 2 months salary, that is known as termination benefit or termination of the employee. So employee includes directors and other management person. Employees means the normal employees, managers, senior managers, directors, other management personnel also. An employee may provide services on a full-time, part-time, permanent, casual, or temporary basis. Either the employee can work on a full-time, part-time, etc. XYZ. Now, what are the four types of employee benefit? The first one is short-term benefit, then long-term benefit, post-employment benefit, and termination benefit. In your exam, the third one and the fourth one is very important. The post-employee benefit plan is the very important. Termination benefit in one or two past papers they have tested, and you have to just write down this employee benefit. The termination has a link with your IS 37. We will discuss it. Now coming to short-term employee benefit. So what does short-term employee benefit means? See here. Short-term employee benefit includes employee benefit expected to be settled only before 12 months after the end of the reporting period. That means this is the reporting period. After that, within 12 months, in the next 12 months, if it is settled, it will be what, sir? short-term employee benefit, in which employee render the service. So employee will render the service here, but the benefit will be paid this time, the next year. But will the company record the expense next year? No, the company will record expense this year based on accrual principle, accrual and matching principle. Now example, see here, wages and salary, profit sharing bonus. If the company is giving some bonus, then short-term compensated leave. If you have taken any leave, etc., XYZ, how will the company do the accounting? We'll see that. Other short-term employee benefit also, non-monetary benefits like medical care, housing, etc. All these are short-term benefits, and the company will record this as an expense when in the period when the employee will render the service. That means the employee is working for this year, but the payment is done the next 12 months. Within next 12 months, the company will record the expense today. So recognize as an expense and liability when employee has rendered service at undiscounted, you should not discount, undiscounted amount. Present value will not apply because this has to be settled within 12 months. So it will be recorded in what? Operating category. So what is the entry? If benefit is received, that means as an employee, if the employee has received the benefit, the company will record as an expense and say that the cash we have paid. If benefit is received and the amount is not paid, then the company will record this as a payable outstanding liability. Once it is paid, they will the liability and they will say cash is paid. Then benefit not received but amount is paid. Amount is paid but you have not received the benefit. That means the company has received. The company is paying the amount in advance to the employer. So it's a prepaid expense, credit cash amount. An important point, whenever a short-term benefit expense is there, and that if you're paying some salary, etc., to employees who are working on the construction of a factory, then that will not be recorded as an expense. It will be capitalized to the cost of the asset. So short-term employee benefit will be recognized as an expense unless included in the cost price of asset due to the requirement of other standard. Like when you manufacture inventory, when you construct a warehouse or building for your business use, then whatever is the labor cost or employee cost will be capitalized in the cost of the asset, and over the period it will be depreciated. This is short-term employee benefit. Then short-term compensated absence. In that case, what we will do? This is the accounting for leaves. That means what? Understand. Today, an employee is working. If the employee will work for 3 in a year, how many days are there? 365 days are there. If the employee will work for 300 days. Yes or no? 65 days is national holiday. Now, even though the employee will work for 300 days, he will get an annual salary of how much? 10 lakh rupees. But if he works for 300 days, he will get 10 lakh rupees salary. But the company will say what? That you can take 10 days leave. Even though you will not work for 10 days, still you will be getting how much? 10 lakh rupees. So now the employee will do what? The employee will use this leave. So the employee will use this and the employee will work for 290 days. If the employee is working for 290 days, the expense for the company will be what? 10 lakh rupees per year. But now what is the employee doing? The employee is saying that I am working for 300 days. Then the company will say what? Okay, you have worked extra 10 days. Even though you work for 290 days, 300 days, the salary will be 10 lakh only. But the employee is very good. He's working for 300 days. Now, for this 10 days, will the employee get any extra payment? That depends on the company. If the company policy is very good, then the employee will be getting the payment for the 10 days also. If not, the company will say what? These 10 days payment we will not give you. These 10 days you can carry forward the next year. If in the next year cash is paid, in that case, will you recognize the expense in the next year? No. The expense will be recognized this year because the employee earned the income this year, the previous year, because he have worked this year, the previous year for 10 days. In the next year, normal cash payment will be recorded. So the company will do what? The company will record 10 lakh rupees as an expense. And further, for this 10 days also, the company will record additional expense. Detailed calculation will not be there. In one of the two past papers, you have some basic questions regarding this in theory. So see now, if leave is used during the year, that means the employee have used. So benefit is already used up, no future obligation, no treatment. That means out of 300 days, the employee is working for 290 days, he'll get a salary of 10 lakhs. The other one, then If leave is not used within the year, that means the employee is not taking the benefit for the leave, he is working. In that case, what can happen? Non accumulating, that means you can't carry forward. That means the company will not pay you anything. The company will say it's your mistake. Why did you work for 10 days extra? In that case, the company need not pay anything. The company will do no accounting treatment. No treatment will be done. But the company's policy is very good. The company will say that you can carry forward this. If you can carry forward, there are two things. Either the company will say that you can accumulating, you can carry forward. That means it can be vested. Vested means cash will be given against the leave. So this year you have worked 10 days extra. In the next year, we will give you the cash. In that case, recognize as an expense when the employees provide the service that entitles them to the leave. That means employees earns the leave. Even though in this case I mentioned the 10 days payment is done in the next year, but the employees have earned this when the employees have earned in this year, the previous year. So what you record 10 lakh rupees as an expense, and for this additional 10 days also we record as an employee benefit expense, and we record a payable. In the future, in the next year when we pay, we remove the liability and we say that the cash is going out in case of cash. But in case of leave, what will happen? In case of leave, that means the company is saying that you can carry forward this leave. We will not give you cash. In the next year, what you can do? Again, what you do? Instead, now next year, what will the company say? That next year also you have to work 300 days, and 10 days you have as a, you can take leave. Each year 10 days you can take leave. Even though you take this leave for 10 days, you will be getting the payment of how much? You will be getting the payment of 10 lakh rupees only. Now understand. So next year also, what is the salary the company, the employee will receive? 10 lakh rupees only. Now coming to an important point here. Now this year the employee, if the employee is working for year also, I have 10 days already and going on a trip. So he will work for not on board others.
Yes, sir, you're not audible.
Not audible. Oh, I'm audible.
Not much, sir. Chalo, now we were discussing what? We were discussing regarding the leave part. So in this case, the first case was what? Cash is paid. If cash is paid, that means the company will record this year as an expense and will record it as a liability. But what did I mention? The employee will say that we will work for 280 days and we will still get the payment of 10 lakh rupees this year. In that case, what will the company do? In that case, you will say that sir, the company should record 10 lakh rupees as an expense. This is not right. This is wrong. So what should the company do? The additional 10 days payment which we are making should be reduced from this salary. Should be reduced from this salary. Now see, employee earned the leave, debit leave compensation, credit provision for the leave compensation. Cash is paid next year. So debit provision for leave compensation, credit cash or bank. Then here, if in this case, what did I mention? Recognize as an expense when the employees provide the service that entitles them to the leave. So you record previous year only the expense because the previous year the employees have worked for 10 days more. You will take into consideration that point and you will record it as a provision. So in future, once the payment is done, we will remove this provision. So how what you'll do?
next year's salary is reduced by this provision amount. And when you do the provision amount, you will take into consideration the expected value. You will take into consideration the expected value. In a regular class, we have done 2 basic questions regarding this, but in any past papers, I have not seen such questions regarding calculation. Even though if a question comes, it will come regarding theory only. So in theory, you should write down based on accrual principle, the expense should be recorded previous year only because the employee has earned in the previous year. So with this, the leave part is also completed. Then coming to bonus. Bonus means what? Bonus will be paid when the shareholders will give a target to the directors or the employees. In that case, the bonus will be paid. Bonus should only be recognized when there is an obligation. Either it could be a legal or constructive obligation. An estimate should be made. In that case, if condition to receive bonus is met by the employee, then what will the company do? The company will record it as a expense and it will record it as a provision saying that we have to pay this. Bonus is paid after the accrual, yes or no? Once bonus is paid, the provision you will reduce and you will credit cash or back. Now, how should we calculate the bonus calculation? Amount of bonus per employee into the number of employees who have met the condition. It depends upon the employee to employee. No? Each employee will have a specific target and the bonus amount will be there. On that basis, the company have to do the calculation. Bonus is paid only if the employee stays till a certain date. So estimate it after adjusting for those likely to leave. So whenever you do the calculation for bonus, the company will say that if you work for the full year and if you are in the company, then only you'll get the bonus. If you will leave, you will not get the bonus. So in that case, the company should take into consideration this also, whether some employees will leave in the future or not. If they will leave, they will not be getting the bonus amount. So this also we have covered. This was regarding your short-term benefit plan. Now coming to the most important topic, that is post-employment benefit plan. A very important topic. A format is there, follow that format and write down simple lines that where will current service cost go, what will be present in the balance sheet, whether loss or gain is there, whether remeasurement gain or loss is there, etc. XYZ. So post-employment benefit plan means once an employee retires, after that the company will pay them what? The company will pay them the amount like your pension, etc. But for 20 years you're working, after 20 years the company is paying you the pension. In that case, the company will not record the expense after 20 years. The company will record the expense this year only based on for each and every year they will record this as an expense. For 20 years, every year expense will be recorded. The calculation is in detail. We have done with a basic example in our class, but that will not be tested in your class. Yes, accrual basis. Accrual basis only. The principle which you follow is accrual and matching principle. As the employees are generating revenue, you record the expense. So now there are 2 types of post-employment benefit plan. The first question that can come in your exam is identify whether it's a post-employment benefit plan or post-employment benefit plan or contribution plan. So in contribution plan, if I am the employer, I will only contribute the amount into your scheme. After that, it depends. If I deduct this from your salary, I deduct a certain amount, I invest it. In that case, in contribution, employee will take the risk. Employer will never take the risk. Understand that. In case of contribution, who will take the risk? Employee will take the risk. Employer will never take the risk. Employee will say that we have given the pension amount to the government. Now, once after 20 years, you should ask the government. If you get out of 10 lakh rupees, if you get 1 crore, it's your benefit. Out of 10 lakh rupees, if you get 0, it's yours. It's your headache. But in case of defined benefit plan, the contribution will not be fixed. But the benefit which you'll be getting after 20 years will be fixed. The company will say after 20 years, this is the amount which you'll be getting. In that case, we say it's a defined benefit plan. In defined benefit plan, the risk is taken by the employer, not by the employee. So that is the reason when you see defined benefit plan, every year the company will keep on investing the amount so that whatever is the goal or the target, they should meet it. Now coming to defined contribution plan. In defined contribution plan, what will happen? In plan under which an entity pays fixed contribution, etc. I mentioned that risk is taken by whom? Risk is taken by the employee, not by the employee. So here, see, and the in defined contribution plan, what is the accounting treatment? The accounting treatment is same like your short-term benefit. So debit employee benefit expense, credit contribution payable. If the company has not paid, they will record it as a liability or payable. If they are paid, directly they'll record what? Credit, cash or bank account. I hope it is clear to you. So how do we calculate the salary into the contribution percentage? This is known as defined contribution plan, where the risk is taken by the employee, not by the employer. In defined benefit plan, the employer will have a variable contribution, but the amount which the employee will receive a fixed amount. Guaranteed predetermined benefit will be given. So in this case, defined benefit plan is a plan where the benefit is defined, but the amount of obligation is not defined. So you have to do this format. You have to prepare this format and do your calculation. And then you will write down the net figures. You will write down the net figures. Yes or no? If I say my fair value of the asset is 100 here, and this is how much? 200. So in your balance sheet, what will be the value? You will show net here. So can I say there is 100 of deficit? It's a deficit bit here. It's a deficit because your value of liability is more, the value of the asset is less. So it's a deficit. Now interest you charge on plan asset, and interest on this plan asset you will get an income. On this obligation you get what? Interest expense, because the company have to pay. The company have to pay after 20 years. They discount it. We have done an example in the class, but as of now, remember, for the exam this format it's enough. So interest we take, then we take what? Present value of the obligation. On this also we charge an interest. So this will be what? An interest income. This will be an interest expense. So if I say your deficit is more, can I say ultimately we'll have interest expense only, net interest expense. In your balance sheet, you will record the net deficit or surplus and net interest income or expense. Then you have contribution. Contribution means what? Amount contributed to the plan. It will increase the value of the plan assets so that the company can meet the obligation in future. Then benefit paid. That means some employees have retired. We have to pay them. So you reduce the value of plan asset and you reduce the value of the plan obligation. And I mentioned regarding the signs, positive sign or negative sign. If you're using positive sign for asset, use negative for liability. If you're using negative sign for liability, if you're using positive sign for liability, use negative sign for asset. Vice versa. Do not confuse in that. Current service cost means each year what is the expense that the company should record. That will increase our obligation. Then gain or loss on settlement will affect your obligation again. Then past service cost also will affect your obligation. Then you do the total. When you do the total, the closing balance will be given. Always it will be given. It's not the duty of the accountant to do this. This will be done by the actuary. Then what you do, you compare these two values. I say my value of the asset is 100 and it is 120. So can I say the value of the asset is increasing? Where will you take this? In OCI. You will take this in OCI. This, if I say the value of the liability is 100, this is 120. Can I say 20 will be taken to OCI? This will be what, sir? This is a loss. And this is what? A gain of 20. Gain of 20. I hope everyone understands. Now coming to the important point. I hope everyone knows the formula. Now see each and every term. Defined benefit obligation means what? It is the present value of the expected future payment required to settle the obligation resulting from employee service. That means, if you remember, we had seen the formula also, 1% into the final drawn salary into the number of years. This final salary was based on the incremental, etc. And then we did divided by, if I say the expense was 10,000, we did this for 5 years. The employee is working for 5 years. So each year the expense was 2,000. And this 2,000 for each year, you were doing what? You were discounting it. And once you discount this, this becomes what? Present value of what? The present value of the defined benefit obligation. So the first year you will say discounted value. So debit, credit. Debit we used to record what? Current service cost and present value of defined benefit obligation. Then second year what you used to do? Again this 2,000 you were discounting for 2 years and considering the value. Then this for third year, etc. This was continuing. The calculation will not be tested. This will not be tested, but this will be provided in the exam. So now see, current service cost and present value of the obligation is determined by projected unit credit method. So present value discount rate determined by reference to market yield to government bonds as on the reporting date or government bond. Yes or no? Government bond that should be of high quality. High quality. Or in the question, they could also mention that corporate bonds. It could also be mentioned what? Corporate bonds. You have to use that, and whatever is the income on the corporate bond or government bond which are of very good quality, that percentage will be taking to discount the value. Actuary will estimate the amount of obligation under various uncertainty. Yes or no? They take a lot of assumption. How many years the employee will live, how many what will be his salary, will there be a growth of 5%, 6%, etc. A lot of things will be taken into consideration. What will be his retirement age, a lot of things will be taken. Then interest cost, what we do, sir, defined benefit obligation is the increase in the value. Your interest cost is what? Interest cost your interest cost is what? Interest cost is the increase in the value of the defined benefit obligation because of the passage of time, because we have discounted it. So you take what? Opening value of the DBO into discounted. Where will you record this? You have to mention in your question the opening balance will be given. Take the discount rate, calculate the interest, and just write down a simple line. The interest cost will go to P&L under financing category, and it will increase the value of the defined benefit obligation. Then current service cost. Current service cost is the increase in the present value of the defined benefit obligation. Defined benefit obligation resulting from the employee service during the current year. Every year we have to record expense, so it becomes an obligation for the company. So this current service cost will be recorded as an expense in the P&L in the operating category, and it will increase the value of the defined benefit obligation. So this current service cost will be given in the exam. The number, take it and just frame a sentence. Then past service cost. Can I say why will past service cost be? Past service cost will be because of the increase or decrease in the number of employees. Either the employees are increasing or either the number of employees are decreasing. Or past service cost also will happen because of amendment in the plan. If there is change in the estimate or assumption, it will be taken care by the actuary. If there is an amendment in the plan, this 1% of salary we have done, it becomes 2% or 3%. In that case, we say amendment is there. In your exam, the value will be given saying that this is the past service cost. So past service cost is the increase or decrease in the present value of the defined benefit obligation for employee service in prior period. If you are increasing the expense, that means for previous year also the expense should be increased. But previous year, will you be able to do retrospective treatment? No. Actually, we should do retrospective treatment, but it's not possible. So the IFRS IAS 19 says follow prospective treatment only. So plan amendment. So there is an increase or decrease in the finance cost. When it could be because the plan is amended, or curtailment. Curtailment means what? Significant reduction in the number of employees. That means the company will say that today 100 employees are there. We'll only be able to pay to 80 employees. They're reducing the 20 employees. Or the company will say that we are closing the business, so we'll not be able to pay the amount to you. If the company is not able to pay the amount, that means what will happen? The obligation will be removed from the book. So see here now. Past service costs are recognized in profit and loss at earlier when the plan is amended or curtailment occurs and the entity recognizes a provision for restructuring cost or termination benefit. You need not remember this, but what you have to remember this one. It will be given in the question. So past service cost will go to P&L under which category? Operating category. If there is an increase in obligation. If there is a decrease in obligation, it will reduce your operating cost. It will become an income and it will reduce the value of the obligation. So we have discussed current service cost, we have discussed interest cost, past service cost. Now coming to actuarial gain or loss. When will this happen? Some amount is given, you write down some amount and you do the total and the closing balance is given. So whatever is the difference is known as what? Actuarial gain or loss. This actuarial gain or loss will be recorded where? This actual gain or loss, remeasurement gain or loss are recognized in OCA, not reclassified to P&L in the period in which they occur. So this will not be reclassified. This will not be reclassified. So there will be actual gain or loss for defined benefit obligation as well as the it will be for your fair value of the plan asset. For both it will be there. Then debit credit, we have seen this. Then actual gain. So what will you do? The value of the obligation will reduce and we will record this as a gain. If there is a loss, we will increase the value of the obligation and we record it as a loss in OCA. If liability value is increasing, loss. Liability value decreasing, it's a gain. Then coming to plan asset. To meet the definition, to meet the obligation, the company will do what? Every year the company is deducting the amount. The amount which they deduct, they will take it and they will invest it. They will invest that amount somewhere. So that investment will be known as plan asset. So planned investment made by an employer for meeting the obligation, employee benefits. Plan asset can include stock, bonds, mutual funds, etc. A lot of things. Assets are not available. Assets are not available to reporting entity own creditors even in bankruptcy. That means what? Even though the company is facing financial difficulties, whatever is the amount in the plan asset, the company can't use it because this belongs to the employee. The company can't say that we are in bankruptcy, so we will take the amount and we will use for the business, will not pay to the employee. This is not allowed. Your plan asset is always recognized at what value? It is recognized at fair value. Excuse me. See now the contribution. Contribution will do what? Investment made in the plan, it will increase the value of the asset and cash will go up. Expected return. Expected return means what? Expected return means the return which you get. The return which you get, the interest income like dividend you get, in capital appreciation in the mutual fund value, etc. So it will increase the value and interest income. It will be shown as financing capital. When you do this calculation, you have to see properly the contribution and benefit. If the contribution and benefit are paid today only on the first day, then reduce it and add it and then do the calculation. If contribution and benefit is made at the year end, then what will you do? No issues. Take the opening balance, multiply the interest rate. If the contribution and benefit is made at the beginning of the year, then what you do? You take the opening balance, you add contribution less benefit into interest rate. I have not seen such question in your exam. Most of the time, it will be at the year end only. Then what is the actual return? This was the expected return. Actual return will be what? Expected return plus actual gain or loss on plan asset. The value of the plan asset will also increase. So in this case, we have to consider that. That will be your actual return. So benefit paid means what? So benefit paid means we are giving the amount to the employees who have retired. So we reduce the value of the plan asset, we reduce the value of the obligation. So first the company will withdraw the amount from the plan asset and then give to the employees. So there will be two entries. If you pass combined journal entry, this is the one. Actual gain or loss on plan asset, what we do, the difference, it will be taken to OCI and it will not be reclassified to PN. Same like your liability part. Then coming to the next important topic, settlement and curtailment. A very important topic that comes in your exam frequently. So settlement and curtailment means what? What did I mention? Curtailment means what? Reduction in the number of employees. If there is a reduction in the number of employees, will the company pay them? Is it compulsory? That depends on the company's policy. If the company is saying that we will not pay them, then you will reduce the value of the obligation and you will record in P&L as an income. If the company is giving, if the company is paying some settlement amount, then whatever is the difference will be recorded to PN. CN. I said today the obligation was 100,000. It is 100. The company is saying that this is the present value of the obligation for the employees in case of curtailment, in the reduction of the employee. So what will the company do? Debit, credit. They will reduce the obligation and they will record in P&L as a gain. Because previous you have recorded this as an expense, now you are recording gain. But the company is saying that we will do settlement, we'll pay to the employees so that they will be happy. In that case, the company is saying that we will pay them 120. In that case, what will happen? The obligation though will reduce by 100. Then can I say what will happen? The company will say that plan asset 120 and what will be the other thing? In P&L, it will be a loss of 20. This loss is known as what? Gain or loss on settlement. This is a loss now. Loss on settlement. That means we are paying more amount here. So see here now. A settlement occurs when an entity enters into transaction that eliminates all further future legal or constructive obligation for part or all of the benefits provided under a defined benefit plan. That means whatever obligation the company has, the company will remove it. So whenever the company will remove, what will happen? Either there will be no settlement. Curtailment means cancellation of defined benefit plan. So curtailment means what? We are cancelling the plan. The gain or loss on settlement is the difference between what? Present value of the defined benefit obligation on the date of settlement and the settlement price. Plan or plan asset transferred and payment made. Either the company will say what? We have transferred you 100, but they are saying that we are paying you 20 also, then the 20 will be recorded as an expense in P&L. The company says that we have taken out the money from the plan asset only 100 and obligation is also reduced by 100, but extra 20 we are paying on that. That will be a loss. See here now, the value of the obligation will reduce. Cash or bank, you will have gain or loss. This cash or bank can be plan asset also. Depends upon the company. What is the amount the company will take out from plan asset and use it for this one. The next one, if a curtailment and a settlement occurs together, there is no need to distinguish between a past service cost and gain or loss. Whenever there is a curtailment, you need not separate what is the past service cost and what is the gain or loss. Directly write down or directly write down a single amount saying, okay, this is the amount that will go to P&L. Then coming to the next one, presentation of DBO and plan asset in balance sheet. How will you record in your balance sheet? You will record it as a net value. You will record it as a net value. I mentioned to you. Obligation, plan asset. If I say it is 100, it is 120. This means what? It is a 20 is what now? Surplus here. Now if I say this is a 120, this is 100. That means what? 20 is deficit here now. So this will be what? Under non-current asset will show this. This will show under non-current liability. Then see now, note, if the present value of the DBO is less than fair value of the plan asset, then the plan asset has a surplus. Now the entity has a surplus in a defined benefit plan. It shall measure the defined benefit plan at lower of two things. Why? The concept of asset ceiling will come into picture because of prudence concept. Now they say that how much is the surplus? 20 is 20. Now there is a limit. You can record this at lower of two things. Lower of 20 or present value of the cash flow which you will receive in the future, or or the present value of the reduction in the contribution in future. This will be, if the company is saying it's 10, that means what? The asset ceiling is 10. Then what is the difference here? Can I say from 20 we should shift to 10? So the further difference of 10 will be recorded in OCI. So in OCI, how many amounts are there? In OCI, we will record remeasurement gain or loss on plan asset, remeasurement gain or loss on present value of the obligation, defined benefit obligation, as well as the asset ceiling difference also we will record in OCI only. So see here now, the surplus in the defined plan and the asset ceiling determining using the discount. So asset ceiling is what? Asset ceiling is what? The present value of an economic benefit available in the form of refund from the plan. What is the refund you will get? Or reduction in future contribution to the plan. As mentioned, this will be given 100%. This will be given in the question. Take that amount and do the accounting treatment. So can I say there will be the value will decrease? In that case, we say it's a loss. It will be recorded in OCI and you'll reduce the value of plan asset. You have to mention that the asset ceiling will be recorded. So the 10 rupees will reduce the value of plan asset and it will be recorded in OCI. Now this asset ceiling will only apply in what case? The asset ceiling will only apply in case of surplus. In deficit, asset ceiling will not apply. So with this, we have completed the concept of this one. Any doubts in employee benefit? I hope there is no such doubts. We have done the revision properly. Now coming to long-term benefits. Long-term benefits means what? Long-term benefits are like your long-term paid absence leaves, then deferred remuneration, profit sharing and bonus which are not paid within 12 months, which are paid after 12 months, long-term disability benefits, a lot of. In case of long-term benefit plan, the accounting is what? The accounting for long-term benefit plan is similar to defined benefit plan for post-employment benefit, is copy paste same. But what is the one difference? Except remeasurement gain or loss will be recognized in P&L, not in OCI. So where will you recognize? You will recognize this in P&L, not in OCI. I have not seen questions regarding long-term benefit plan. Most of the time the questions are regarding your termination, bonus and your post-employment benefit. The reason being, measurement of other long-term employee benefit is not usually subjected to the same degree of uncertainty as the measurement of post-employment benefits. When coming to your post-employment benefit, the uncertainty was very high because a lot of things were estimated. But here, estimate is not much. The following items will be recognized in P&L: service cost, net interest on defined benefit asset and liability, and any remeasurement of defined benefit asset or liability. All this will go to P. Same copy paste. Only the difference is remeasurement gain or loss will be recorded in P&L rather than OCI. So this is clear. Then chalo last one, termination benefit. Termination benefit means when the employees are terminated, the company pays some amount that should be recorded as an expense. Termination benefits are employee benefits provided in exchange for the termination of an employee's employment as a result of either entity's decision to terminate an employee's employment before the normal retirement date, that means before the retirement, the entity is deciding that, okay, we do not require this employee, we'll say him to resign. Then the other, employee's decision to accept an offer of benefit in exchange for the termination of the employment. That means either the company will say you get out, or the employee will discuss with the company and say that I will not work for this company and take a letter saying that I am resigning. In that case, some benefit, if the company is paying the benefit, then only the accounting treatment will come into picture. If they are not paying anything, then no accounting treatment. Understand that? Employee's decision to accept an offer of benefit in exchange for the termination of employment. That means the company is giving an option to the employee to leave the company and they are paying some amount to them. Termination benefits are usually lump sum payment but may include enhanced post-employment benefit and salary paid during the notice period when no work is done. So when will you recognize this termination benefit as an expense? Entity should recognize termination benefit expense as an expense in which category? Operating category and corresponding liability at the end of earlier. So they should record it as an expense. If the amount is paid, very good. If the amount is not paid, then liability should be recorded. When can no longer withdraw the offer of the termination benefit. That means the company has given the offer and the employee has taken it. So we can't change this. And recognizes cost for a restructuring provision, and the restructuring involves the payment of termination benefit. So sometimes what will happen, the company will say that, okay, we are firing the employees. Okay, in that case, on that day, the company will record this as what? An expense and record it as a liability. But sometimes what will happen, the company will say that in the coming 6 months, we will shut down our business. So we'll pay you termination benefit. In that case, today only I know that the definition of restructuring provision as per IAS 37 is being met. So today only we will record the expense for termination benefit. But if the employees are working for 6 months before the termination, that company is paying any salary. The salary which is paid during that 6 months will be recorded each year. But the termination benefit will be recorded today only, even though after 6 months the company will shut down. If some employees are exercising today, the company will do the payment. No issue. If the employees are exercising after 6 months, once the company will shut down, in that case, the company will record an expense today and record a liability. If normal salary is paid, that will be recorded as per normal accounting. Every month they will record it as an expense. So measurement depends on specific terms. If termination benefits are expected to be settled wholly before 12 months at the end of the reporting period, apply short term, recognize it as an expense to P&L, no discounting. If the termination benefits are not expected to be settled wholly before 12 months after the end of the reporting date, apply other long-term benefit plan, recognize it as an expense to P&L, discounting. That means we have to recognize it as an expense and you should treat this as per discount. You should discount the value and every year you should unwind it, as well as once you do the payment, you will remove the liability from your books. So with this, your IAS 19 is also complete. Any doubts to anyone in IAS 19? No doubts, no doubts. Okay then. I hope it is clear to everyone. So with this, IAS 19 is done. Your financial instrument is done. So now I will do IAS 12 deferred tax. It will not take much time. After that, IAS 36 and IFRS 5, I'll not do. You can just refer the revision video of FR. Yesterday I have done that. After the last part, it was covered in last only. So you can refer that. This one. IFRS 5 and IAS 36 for impairment. I have discussed that. So now coming to the last topic, it will not take much time for this one. Now coming to income taxes. So when coming to income tax, this income tax is a separate heading in your P&L. If you know, can I say profit? You have your operating profit, then you have your investment income, investing category, then financing category. After that, you have profit before tax. Then you have a separate heading known as income tax, and for that income tax we will refer IAS 12. Now this standard is not frequently repeated in SBR, but there are 2 to 3 areas which are tested. So now income tax will include what, sir? Income tax will include two things. Income tax will include current tax, and the income tax will include what? Deferred tax. So now what is current tax and what is deferred tax? Understand. Income tax will include what? Current tax and deferred tax. Let me take an example so that the concept of deferred tax is clear to everyone. So see here now, this example. The cost of an asset is how much, sir? 10,000. See, I hope it should be clear to each and everyone that the accounting books are different. The accounting books are different and the tax books are different. Because accounting profit is different, taxable profit is different. You calculate or you pay the tax on the taxable profit. You do not pay the tax on accounting profit. But when we do the accounting books, we calculate the income tax based on taxable profits and plus any difference which is that. That difference will be known as deferred tax. So see here now, cost of an asset is 10,000. Depreciation is charged at 20% on SLM based on the books. Depreciation is charged at 25% on the SLM in the tax book. Okay, in your accounting books we follow 20% and here we follow 25%. Understand what is deferred tax? Deferred tax is a difference because of the accounting rules and the tax rules. So profit before depreciation and taxation per annum from year 1 to 5 is 20,000. So this is a profit before considering what? Depreciation as per income tax as well as your accounting books. So now depreciation as per accounting books is how much? 2,000. The depreciation as per income tax book is how much? 2,500. So now when I do the calculation as per the books, my accounting books, what will I do? 20,000 minus 2,000, 20,000 minus this I'll record, and we get the income here 18,000. On this 18,000 we normally say what's a 30%. We say the expense should be 5,400. But do remember, you never pay tax on the accounting profits, you pay tax on the income tax profit. So the income tax profit is how much? 20,000, but here depreciation is 2,500. So how much is this? 17,500. So what is the tax rate? The tax which you have to pay is 5,250. But how much is the tax expense as per accounting books? You say 5,400. You will say, sir, we are very happy that we are paying a less tax here. Yes or no? But it's not that way. The tax authority will say that today you are paying less, no issues, but in future you have to pay it. So that means your income tax will include two things here now: current tax and deferred tax. So my current tax here is how much? 5,250, and my deferred tax is 150 here. 150. Why this 150 came? Because of the difference in the accounting rules and taxation. But ultimately in PNL we record 5,400 on it. This current tax is 5,250. So see here now, ultimate we pay how much? 27,000. Here also we pay 27,000. But in the last year we are paying more. So you should not be happy saying that okay, my interest expense is 5,400 but I'm paying 5,250. No, 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 no. The tax authority will say that you're happy now, but at the end you have to cumulatively pay 400 extra, because every year you're getting 150, 150, 150 benefit. So 600 you have to pay extra. So you pay at the. So the reason this difference is known as what? Deferred tax. And deferred tax will be on matching principle concept. Matching principle. Understand that. Excuse me. So I hope this is clear to everyone. So I hope everyone have understood what is deferred tax. Current tax means what? Amount of tax payable, recoverable in respect of the taxable profit as per tax rules. Deferred tax is what? Deferred tax. The amount of tax payable or recoverable for future in respect of temporary difference between the carrying amount. Can I say the difference was for temporary period? After 4 years, ultimately you have to pay the full amount. That will be your deferred tax. Now, accounting profit means what? Profit and loss for a period before deducting tax expense as per IAS and IFRS. Then taxable profit and loss for a period determined in accordance with the rules and regulations which are given by the tax authority. Each and every country will have its own rules and regulations. Then temporary difference means difference between the carrying amount of the asset and liability in SOPL, SOFP and the tax base. Yes or no? Can I say there was a difference here? If you see in this question, The asset value was 10,000. So my carrying amount was how much? 8,000. Here it is 7,500. So difference is there for some period. At the end of 5th year, both will become 0. Then let me discuss now current tax. What is current tax? Current tax is what's a taxable profits into the tax percentage. That means it is an estimate. This year tax you pay next year. This year tax you pay next year. So when you pay next year, but today you have to record expense. So what you do, you estimate the amount. So you record current tax expense and you record provision for current tax in liability column, because this year tax is paid next year. Any difference between the estimated and actual amount paid will be recognized in profit and loss in the period of the payment. Today I recorded an expense of 5,000, but in the next year I had to pay 6,000 to the tax authority. In that case, this 1,000, what will I do? I will record this as an expense in the next year. I will not do retrospective treatment. It is an estimate. For estimate, prospective treatment is done. Under or over provision, let us discuss this. Under provision means what? Current year you recorded 50/50 as an income tax, but next year for this 50, how much you're paying? But next year for this 50, you're paying 60. So you're paying 60 in this case. But how much is the provision? We record 50. So 10 is the extra expense which we record in the next year. In year 2 also, year 1 tax you're paying in year 2. Year 2 also will have tax. So you'll record that income tax of 70 and 7. Then next year for in year 3 you'll pay this, and year 3 tax expense will be there. The cycle will continue. Over provision means what? In the current year you have recorded 50 and 50 as the expense, but in next year you are only paying 45. If you're paying 45 but you have recorded it as an expense of 50, that means 5 is an income for you in the PN. So you credit saying PN because previous year we recorded more income tax, this year we are recording less. In year 2 income tax also will be there, you will record that normally. So with this, your under and over provision is clear. This will not be tested. Your under over provision I have not seen in your SBR. If you get, you should be able to attempt and write it. Now coming to the next thing, types of differences. The types of difference are what? Permanent difference, temporary difference. In case of temporary difference, we will create a deferred tax asset or a deferred tax liability. If there is a permanent difference, will deferred tax asset and liability be created? No. Difference has no tax consequence like government grant, donation, fines and penalties in that case. Now coming to the next, temporary difference will have a tax consequences. So like your example, development cost, depreciation, interest expense, a lot of things we have covered in the class. Now coming, sir, how should we determine whether we should record a deferred tax asset or we should record a deferred tax liability? A question comes. Liability means it will show under non-current liability, current liability. And this will create an income. Income means it will reduce income tax. This will what? Expense. It will increase income tax. Increase income tax. Now see here. Taxable temporary difference, deductible temporary difference. Okay. So to record a deferred tax liability, it should be a taxable temporary difference. So taxable temporary difference means today you are paying less tax, but in future you have to pay more. Additional payment of tax in future, that means taxable profit will increase in future. In future you have to pay more tax, but today you are paying less tax. In that case we record deferred tax liability. So in which case you should follow the balance sheet approach. We will not follow the P&L approach. In balance sheet approach, what we do, if the carrying amount of the asset is more and tax base is less, you compare carrying amount as per tax book, you compare carrying amount as per accounting books. So both the carrying amount of the asset in the accounting book and tax base you compare, so that you get the difference. If the carrying amount of the asset is more, tax base is less, what we do? Can we reduce the value of the asset? No. Can you do any changes to the tax authority? No. So what will you create? A DTL. DTL you will create a opposite entry. You create a DTL so that the value of the asset will come down. If I say the value of the liability is less when compared to the tax base, can we change the tax base? No. But we can change what? We can change the liability. We can increase the liability. We can increase liability. We can increase asset, but we can't decrease the asset and liability. Understand? Deductible temporary difference means what? Today you are paying more tax. In future you will pay less tax. So saving of tax in future. Today it's a burden. In future it is not a burden. You'll be free. The amount which you pay today is more. In future you'll pay less tax. Now, when will a deferred tax asset come into picture? When the carrying amount of the asset is what? Less when compared to the tax base. So you will increase the value of the asset. You create a DTA. In case of liability, the carrying amount of the liability is more, tax base is less. Will we reduce the value of the liability? No, we can't reduce. So we create a DTA, a deferred tax asset. Understood, everyone? The rules. So remember this, very important. It's tax of transaction must be accounted for in the same manner in which the transaction is accounted. If there is a gain or loss, that gain or loss is recorded in the P&L. If this gain or loss will have an impact on the tax, that tax also will be recorded in P&L. If there is a gain or loss, like your revaluation gain is recorded in OCI. Now, because of this revaluation gain, your deferred tax also will be created. That also will be recorded in OCI. So now see recognition criteria. When should the company record deferred tax liability? The company should record a deferred tax liability for all taxable temporary difference. Unless it's an initial recognition of goodwill. When you initially recognize a goodwill in business combination, you do not record a DTL. Initial recognition of asset or liability in a transaction which is not a business combination. In business combination, we record DTA, DTL, but the transaction should not be a business combination. And does not affect either accounting profit or taxable profit. That means if you initially record a goodwill, we will not record DTA or DTL. If, sir, initially we are recognizing a asset or liability in a transaction which is not a business combination. For business combination, we record DTA, DTL. But if it's a normal transaction and it does not affect accounting profit or taxable profit, we will not do anything. Like when you initially purchase any asset, debit asset, credit bank, is it affecting anything? It's not affecting your taxable profit. At the reporting date, it will affect. For deferred tax asset, also same. A deferred tax asset should be recognized for all deductible temporary difference to the extent it is probable that in future taxable profits are there. If in future taxable profits will be there, that means what? You can claim the expense. Today you are not able to claim the expense. In future you will be able to claim the expense. That means today you are paying more. In future you will pay less. Unless initial recognition of asset or liability in a transaction which is not a business combination and which does not affect either accounting profit or taxable profit and does not result in equal taxable or deductible temporary difference. All the three conditions should be satisfied. It should be an initial recognition of asset and liability, and it should not be a business combination transaction. It should not affect the accounting profit and taxable profit, and it should not create a equal taxable deductible temporary difference. If it creates a equal taxable temporary difference, we will record it. Like in case of your lease, in case of your provision, we have seen this. Tax base of an asset is what? Tax base means the carrying amount of the asset as per tax rules, but the formula is given by IAS 12. Amount which will be deductible for tax purpose against any taxable economic benefit that will flow to an entity when it recovers the carrying amount of the asset. So if I say today my carrying amount of the asset is 10,000. So now can I say in future I will be able to claim what? Tax base. Tax base will be what? The amount that the company can claim for future deduction. I said 10,000 is the cost of the asset. 2,500 we have already claimed. So 7,500 is the remaining value. So can I say in future how much is the amount we can deduct in depreciation? 7,500. So this 7,500 will become what? This 7,500 will become the tax base here. Will become the tax base. If those economic benefits will not be taxable, the tax base of an asset is equal to its carrying amount. That means if the asset which is there, from this asset you are getting some economic benefit and that economic benefit is not taxable, in that case the carrying amount and the tax base will remain same. Tax base for liability is what? Carrying amount minus amount that will be deductible for tax purpose in future years. In your question, the rules and regulations will be given regarding the country. What are the tax rules? So please read it carefully and calculate the tax base of that. Now, what are the tax rates? Tax rate is the rate. What is the tax rate which we have to use? Current tax should be measured based on the rate that has been enacted. That means this year, what is the tax rate? Can I say it is already been passed? In February in India, you have budgets. In that budget, the tax rate will be given. That tax rate we have to use for the current year. Sir, for deferred tax, what should we do? For deferred tax, you should use the tax rate in future. whatever is the future tax rate. If you know that, use it. If you do not know what is the future tax rate, in that case we use the current tax rate only, same. But most of the time future tax rate will be available. Deferred tax shall be measured at future tax rate expected to apply to the period when the DTA or DTL will be released or settled. DTA or DTL should be created using the tax rate which is consistent with the expected manner of recovery. Like you could have some capital gain. There are different types of taxes also, no? On capital gain, the tax rate is different, etc. So you have to see the nature or the manner in which you will get the refund. That tax rate you have to use. You can't use the corporation tax. You can't use your corporate tax on a disposal of an asset when you have a gain. If you have a gain, it will be as a capital gain and the tax rate will be different. But if it's for a normal business, like a sale, you're doing some sale, and the income tax will be totally different for the corporate. The tax rates will be different. So now see what are the steps you have to follow. Step 1, calculate the carrying amount as per the accounting books, calculate the tax base as per the tax book, calculate whether temporary difference, it's a deductible temporary difference or taxable temporary difference, determine the tax rate, calculate DTA or DTL. This will be your closing balance and see if there is an opening balance or not. Compare this DTA or DTL with any opening balance and see what is the increase or decrease during the year. Then in balance sheet, under non-current asset, you show deferred tax asset. Under non-current liability, you show deferred tax liability. And deferred tax assets and liabilities should not be discounted because complexities and difficulties involved will affect reliability. That means discounting is not there in deferred tax because it is deferred tax calculation itself is complex, and when you discount it, it will become more complex and the reliability of the data will not be there. Till here the basic of deferred tax we have done. Now what we will do, we will discuss the cases which are frequently tested in your exam. The first case is what? Deferred tax on revaluation. So can I say deferred tax will come? Today I say my carrying amount is 10,000 and the fair value is how much? 12,000. Now can I say how much is my revaluation gain? 2,000. But the tax authority will never believe in the concept of revaluation. They say that we will record it at carrying amount. I say the carrying amount is 9,000. Now you only say carrying amount is how much in the books? 12,000 and this is 9,000. So DTA or DTL here? DT or DTL, you will create a DTL, deferred tax liability. So what is the difference here? So 3,000. Out of the 3,000, if I say 30% is the tax rate, 900 is the DTL. So debit what? It's a loss for you, so you have to record in OCI. You have to record in OCI. Revaluation gain is 2,000. For 2,000, you should record in OCI, and for the remaining 1,000, you should record in PNL. So OCI, I will record 600, and in PNL, I will record 300. This is the account deferred tax calculation for revaluation. So if revaluation gain, DTL shall be credited and charged to OCI. If revaluation loss, DTA shall be created and charged into PNL, which are revaluation gain OCI, revaluation loss directly to PNL. Deferred tax liability on revaluation gain is shown in OCI and revaluation within revaluation gain. That means when you record in OCI, what you record? So we have a revaluation gain less what? The 600 as an interest income tax expense. So the value will be 1,400. And in your OCE also under revaluation gain, it will be shown as 1,400 net figure. We will record the net figure. The first case we have completed, that is deferred tax on revaluation. Then coming to unused tax loss. This has been repeated for more than 6 to 7 times in your past papers. Unused tax losses means what? Now today I say that the company is making profit of 1,000. If the company is making profit for 1,000, can I say the company will pay on this profit tax? So the company will pay 300, that is 30%. Now if the company is making losses, will the government pay to the company? The government will not pay back to the entity saying that if you have done loss, we will pay you. If you have done profit, you pay. No. The government will not give you a refund, but the government will say what? The government will say in future, if you have profits, you can utilize this there. In future, if you have profits, this in future, if you have profits, you can utilize this. So this 1,000 in future, in the next year, you have a profit. So reduce this and record the value as 0. Here also record 500 and only pay tax on the 100 remaining. Pay tax only on the 100. That means if there is losses today, can the company record a deferred tax asset? Because in future they are not paying. So can the company record? Yes. Conditions in. An entity should recognize a deferred tax asset against unused tax losses if it is probable that future taxable income will there. In future income should be there, not accounting income. Taxable income should be there. If accounting income will be there, taxable income will be there for sure. And carry forward is allowed. That means the tax authority should say that you can carry forward it. You can take to the next year. After this, the asset is equal to the tax losses expected to be utilized multiplied by the tax rate. What will you take? Whatever is the difference, you will take this loss and you will multiply with the percentage. You say that 300, I will record it as a deferred tax asset. If the entity does not expect to have taxable profit in future, it cannot recognize an asset. Simple thing. They will not be able to recognize an asset. Any doubts in the first two topic? I hope you are able to remember all these points which you have learned and which we have covered in the class. See, if you think that sir deferred tax will not come as mentioned, one of your friends also have given the exam. They mentioned that they got employee benefit and deferred tax. IAS 16, IFRS 16, IFRS 15 was not there in the question paper. Now gain or loss on financial asset. That means what? When yes. Now coming to financial asset. Can I say in financial asset we have what? Fair value method, fair value through OCA and fair value through P&L. But will the tax authority believe in the concept of fair value? They never believe in the concept of fair value. So in that case, can I say the carrying amount will be 1200? But as per the tax authority, can I say my carrying amount will be 1000 only? So there is a issue here now. So the carrying amount of the asset is more, tax base is less. So deferred tax liability should be created. So see here now. Gain or loss on financial asset held at fair value should be recognized in profit or loss or in OCA. We normally have covered. Gain is not taxable until the financial asset is sold. The gain is ignored for a tax purpose until the sale. That means the tax authority says, okay, the fair value is increasing, but this fair value you can claim once you sell the asset, and the tax base of the asset does not change. A taxable temporary difference arises generally and generating a deferred tax liability. We have seen. Similarly, if fair value loss is there, then it creates a taxable, a deductible temporary difference, and a deferred tax asset will be created. Deferred tax is recognized in the same section. That means if fair value through P&L, deferred tax also to P&L. Fair value through OCA, the fair value difference is taken to OCA, the taxation also will be taken to OCA. This is the third point which we have covered. Coming to the next important point, share-based payment. If it's your bad day in taxation, you can have share-based payment and you can have the accounting regarding lease, which we have done questions, or you can have questions regarding business combination is very easy. Other than this, the chapter is done. So let us discuss now share-based payment. In share-based payment, we have learned what? The share-based payment, the employer will record, the employer will record the, or the company will record the expense over the period. But the tax authority says that once the share-based payment is done, then only you can claim the expense. You can't claim the expense every year. So that means after 3 years, once you do the payment, you can claim the expense. So see now, IFRS 2 share-based payment expense is recognized in profit or loss over the vesting period in relation to share option. Yes or no? Tax relief may arise in a later accounting period. That means exercise date. So the tax relief will not be available for first year, second year, third year. After the third year, you'll get the tax benefit. So can I say temporary difference is there? In the accounting books, every year you're claiming, but the tax authority is saying that after, once the payment is done, you can claim. So accounting expense is based on the fair value of the option, but tax relief is usually given on intrinsic value. So the expense which we record, the expense we record on what basis? The expense we record on fair value. Expense we record on fair value basis. But relief is given on intrinsic value. Intrinsic value is what? Market price minus exercise price. So every time in share-based payment for deferred tax, it will be what? It will be deferred tax asset only. There will be no deferred tax liability. So see here, carrying amount of share-based payment expense will be zero. Less tax base of share-based payment, estimated amount tax authorities will permit as a deduction in future period based on the year-end information. Based on each year-end information, you'll calculate this value. Then you'll get deductible temporary difference. Every time you'll get what? Deductible temporary difference, and you create a deferred tax asset. Now this deferred tax asset will normally be recorded in P&L. But see now, if the amount of the tax deduction exceeds, okay, the amount of tax deduction, can I say the tax deduction is based on what? Intrinsic value? Is based on intrinsic value. So in that case, what will happen? If I say the company says that the expense is 24,000 as per accounting books, but as per tax authorities, they are mentioning the expense on intrinsic value, that is 30,000. So what is the difference here now? 6,000. So now in that case, what should we do? If the amount of tax deduction exceeds the amount of the related cumulative expense, this indicates the tax deduction also relates to an equity item. In that case, the excess is recognized in equity. Whatever is the excess part will be recognized in equity, and the remaining part will be recorded in P&L. So let us do one question which we have done in the class, so that it becomes a revision. As mentioned, very important topic. See here now. So now see the question here now. On 1st January 2008, are granted 10,000 share option to an employee vesting 2 years. So the vesting period is 2 years. The fair value of the option of each option measured at the grant date was 4. Can I say this is the equity settled share based payment, and the fair value of the option is 4. Tax legislation in the country in which the entity operates allows a tax deduction of the intrinsic value of the option when they are exercised. The intrinsic value of the share option was 2.2 million at 31st December 2008 and 4.4 at 31st December 2009. At which point the options were exercised, assume a tax rate of 30%. Required, calculate deferred tax amount to be recognized in respect of share option. So now what we do as per accounting, as per IFRS 2, normal 10,000 into 1 employee into 4 into 1 by 2, 1 by 2. Normally this is the expense we record in P&L, 20,000, 20,000. And how much is the equity value? 20,000 and 40,000. Now as per IFRS 12, what is the carrying amount? Can I say carrying amount will always be 0? Now tax base is what? Can I say tax base is based on intrinsic value? So how much is the intrinsic value here? You can see at the end of the first year, the intrinsic value is how much? 2.2. 2.2. So 2.20 into 10,000 divided by 2. So how much is this, sir? 11,000. So how much is the difference? 3,300. Now how much is the expense for the first year? Your expense for the first year is 20,000. But the deduction, how much you're claiming? 11,000. Can I say it's below only? So no such issues. Directly it will go to PN. The intrinsic value is less than the cumulative expense of 20,000, and therefore DTA is recognized full in the part of PN. So we create a deferred tax asset and we take to P&L this value. Then coming for the next year. Next year, what is the value, beta? Next year, can I say it is 4.4 into 10,000 into 2 by 2? You do 44,000. How much is the difference here? 44,000. How much is the DTA here? 13,200. But can I say here, can I say the expense is how much here now? The expense is 40,000, but the expense which you are claiming is how much? 44,000. So it's an increase here. If it's an increase, what we do? The increase, what is the increase here? Can I say the increase 40,000, 4,000? The 4,000 into 30 percentage, this 1,200 we record in equity. See now, the intrinsic value of 44,000 is more than the cumulative expense of 40,000. Therefore, the cumulative amount of DTA recognized in profit or loss is restricted to 40,000 into 30, that is 12,000. But in previous 2000 exit, we recorded 3,300 in the P&L. So we will reduce that. And so what is total? It is 13,000. Out of this 13,200, 1,200 is equity part. So in the P&L, how much is this? 12,000. So out of this 12,000, already we have recorded how much? Already we have recorded the amount of 3,300. So this year the expense will be 8,700. The excess is how much? 1,200 is part of the equity. So the entry is debit deferred tax asset, credit P&L, and credit equity. This is the amount. Understood, everyone? With this one question, I hope you have understood what should be done. Now, on the exercise date, what will happen? On exercise date, whatever is your deferred tax asset, you will reverse it. You will reverse it and you will record it as a current asset. You will record it as a current asset. So with this part is done. Your deferred tax part is done. Now coming to transaction resulting in an equal asset and liability. That means what? We have covered what? We mentioned that sir, deferred tax asset and liability should be recognized for all taxable temporary difference, deducted temporary difference. If it's a business combination, we record. If it's not a business combination and it does not affect the accounting profit, we need not record. But it should not create equal asset and liability. But in lease accounting and decommissioning, it creates a equal asset and liability. So yes, in that case, depending on the tax rules, the taxable and deductible temporary difference for the assets and liabilities on initial recognition are also equal. IAS 12 initial recognition exemption do not apply and we must recognize the resulting DT and DTL. Although the deferred tax amount initially net off to zero when offset criteria are being met as per IAS 12. The tax base will depend on the tax laws of the country's rules and regulations and which will be given in your exam. Understand that. It will be given in your exam. Now, this lease in one or two past papers, this has been tested. So let me do a basic question so that you will have a good revision of this also. Now see, this one. Now, if you remember the IFRS 16 accounting, I mentioned what? In IFRS 16, what will happen? In IFRS 16, can I say the expense? Can I say this 10,000 which we pay every year is an expense? Can I say to make our life complicated, what we do? We discount the value and then we record the expense in the form of depreciation and interest expense. Can I say if you record depreciation, if you record interest expense, can I say the ultimate expense will be 40,000? If you do every year the payment of 10,000. If you directly record the payment of 10,000, that also will be equal to 40,000. So now when coming to the tax rules and regulations based on country, you have to see that the deduction is given for what? The 10,000 for the payment deduction will be given as per the tax authority. That means the right to use asset is a depreciation into P&L. Lease liability interest will go to. Can I say if this we do this total? Can I say we'll get the lease payment only? Yes or no? Ultimately, we'll get lease payment. What is the total expense which you record? Now you have to see the question carefully. Whether the question is saying that the expense can be claimed for these two or the expense can be claimed for lease payment. Most of the time, the expense can only be claimed for one thing. Either this one or either for these two. See now. Tax authority deduction is for depreciation and interest. 50,000, or tax authority deduction for payment 50,000. Either you can claim for this one, either you can claim for this one. Now you only say me. Now see here, the present value of the lease liability is how much? 10 million, and the tax deduction lease or the tax deduction is based on what? Lease liability. It's not based on your depreciation and interest. So the tax rate is how much? 30%. Now you only say as per IFRS 16 what we record, right to use and lease liability. Now what is the tax base for right to use asset? Can I say the tax base for right to use asset will be 0? Why? Tax base of an asset is what? Amount which will be deductible. Will this amount be deductible in future? No. The amount that will be deductible is what? 10 million. For ROU that is 0. So the tax base will be remain 0. For lease liability, tax base is what? Sir, carrying amount minus amount that will be deductible. Can I say 10 million is the amount? Tax base is what? 10 million minus amount that will be deductible in future. What is the amount that will be deductible in future? Lease payment of 10 million. So here also the tax base is 0. So for ROU asset, it creates a DTL, deferred tax liability. For lease liability, it creates what? A deferred tax asset. Deferred tax asset. I hope everyone have understood this. This is the way you have to do. Even though this is creating equal asset and liability, you still have to record it. Now see here, let us do one question. On 1st January 2005, A entered into a 5-year lease agreement to obtain the use of an asset. The asset will generate taxable income throughout the period. The lease liability at the date was what? 260. And the right to use was what? 290. Calculated as the lease liability plus initial direct cost. Lease payment of 60,000 will be made annually in arrears. Interest rate is 5%. There. Depreciation will be charged to straight line basis on lease term. Tax relief is obtained on initial direct cost when it is paid. Okay, for initial direct cost when we do the payment, and tax relief is obtained on lease payments here. Is this on the depreciation and interest? No, it's on the lease payment. When they are made at the end of each year, A pays tax of 20% and has determined that deferred tax assets and liabilities arising in the legislations can be offset. Then see now, you have to do the accounting for IFRS 16 also, IAS 12 also. As per IFRS 16, the lease liability is how much? 260, 290. Now the lease liability has a carrying amount of 260. Can I say the tax base will be 0? Yes or no? Because 2,60,000 minus 2,60,000, the value is 0. Can I say this creates a deductible temporary difference? This creates a deductible temporary difference. It creates a deferred tax asset of how much? 52,000. Can I say the right to use asset has two things here? First thing is what? Lease liability and initial cost. So can I say the lease liability has an carrying amount of 260 and the tax base is nil? So this will create what? This will create what? This will create a taxable temporary difference. So now see now, the initial cost which we have paid is 30,000 and the tax base is how much? 0. So can I say how much is it? 290,000. On 290,000 we have to calculate taxable temporary difference. So how much is that? 290,000 into 20%, 58,000. So now now 58,000 is there. Now you only say me, can I say out of this 58,000, can I say 6,000 relates to what? This initial direct cost. So what you do? Debit deferred tax asset, credit deferred tax liability 50 to 52. It will offset. On initial cost, can I say it is creating what? A deferred tax liability. So it will be an expense in P&L. So 6,000 and this is that. Understand that. Now see, at the first year end. So how much is the deferred tax expense we have recorded? The deferred tax expense is as of now 60,000 and this will offset. One side you will record an expense of 52,000, on the other side you record an income. So the value will ultimately be 0. So the ultimate net expense will be how much? 6,000 only. Then lease liability. For lease liability, you prepare the amortization table, 260, and then you get the closing value. For ROU, you do depreciation, you get the carrying. Now again, you should compare the value at reporting date. So can I say lease liability is a deductible temporary difference? So therefore, 2,13,000 into 20, so 42,600. Right to use asset also 23,000 or 2,32,232,000 into 20%, 46,400. So now can I say here on the one side deferred tax asset, one side deferred tax liability. But now what is the difference? You see now. Here it is how much? 42,600. Here it is 46,400. So a liability is there because this is a DTA. This is DTL. DTL. So now the difference is 3,800. 3,800. But now you say me how much is the expense you should record in the books? 3,000. When comparing the first year till date, your expense should be how much? Your deferred tax liability is 3,800. But can I say already we have recorded here what? In the previous year we have recorded 6,000 as an expense. So you will reduce here now. See what will you do? Reduction of 2,200. You have recorded 6,000, but how much is the value now? 3,200. So you'll reduce the value of your liability and you will record this as a in a P&L, that 2,200 as a reduction in this. So this is the way you do the calculation for lease. So please do one question regarding this. If by chance in the exam it comes, you will be able to tackle it easily. This one I have not seen being tested. No issues. If you avoid this, it's okay. Now coming to the last important topic, business combination. Now what will happen in business combination? Can I say when we do consolidation, we purchase the assets and liabilities of the company at fair value? If you purchase the assets and liabilities of the company at fair value, in that case, will the tax authority believe in the concept of consolidation in fair value? No. So this will create what? This will create a difference in the value of the asset. This can come an adjustment in your consolidation. Assets and liabilities taken over in a business combination are recognized at their fair value on acquisition date. Temporary difference arises when the tax base of the assets and liabilities acquired are not affected by the business combination or affected differently. Either they are affected differently or either they are not affected. Tax base of such assets and liability will remain at cost of the previous owner. That means A company is there, B company. A company acquired the company. That means when they acquire this, they acquire at fair value. But now what is the tax base? The tax base will be the carrying amount of B company. Whatever is the carrying amount of assets and liability in the B company's book, that we will consider. DTA or DTL will be recognized on such temporary difference and adjusted to goodwill and adjusted with goodwill or gain or bargain purchase capital reserve. So now, if the fair value gain is that means the carrying amount in subsidiaries book it is 1,000, the fair value is 1,200. So can I say this is a gain of 200? This gain will create a deferred tax liability. See, if deferred tax liability due to fair value gain, reduce the fair value of the net asset of the subsidiary and therefore increase the goodwill. So can I say this is a DTL? So what do? You record the purchase consideration plus fair value of the NCA. Then you record net asset at repo at your acquisition date. Then what do you do here now? You take share capital, share premium. Then you take what the fair value of the asset, that is 200, you add it. Here again you have to reduce this DTL. 200 is increase in the fair value, yes, we understand. But whatever is the DTL regarding this 200, let me take it is 30%, 60. So 60 I have to reduce it here. Then I'll get what? My net asset at the repo acquisition date. So in a basic sense, what we are doing, if I say my goodwill is coming to 100 and I have not taken the impact of deferred tax liability, what will I do? I will increase my goodwill to 120 because my net asset value is decreasing. My net asset value is decreasing, goodwill will increase. The next one, deferred tax asset due to fair value loss. If you have a fair value loss, increase the fair value of the net asset on the subsidiary and therefore increase what? The goodwill. You will reduce the fair value of the net asset of the subsidiary and therefore increase the goodwill. So debit goodwill, credit deferred tax liability. Vice versa, if there is a loss, you will record this as a deferred tax asset and you will decrease the value. We will decrease the value of the goodwill here. We will decrease the value of the goodwill. I hope this is clear to everyone. So see now, deferred tax recognized is treated as part of the net asset. So this deferred tax which you have, no, it is treated as the part of the net asset. If you treat this as part of the net asset, then only your goodwill will come down or the goodwill will go up. of the subsidiary at acquisition date and as a result affects goodwill. A very important adjustment. If you have done your past papers, you would have come across this adjustment. Very rare. This is not frequently repeated, but it is an important topic from the consolidation point of view. Now see, unrealized profit in case of consolidated books, if they mention that deferred tax is applicable, intra-group, whatever is the unrealized profit, what we do on that unrealized profit, it creates a deductible temporary difference, giving rise to a deferred tax asset in the consolidated books. It gives rise to what? Deductible temporary difference. That means a deferred tax asset will be recorded. So with this, we have completed the revision of IAS 12. Anyone, any doubts? Any doubts? Or everything is clear? I hope with this, the revision of these standards are done. So tomorrow we'll focus on consolidation revision and the small topics. Your IAS, your IAS 36, IFRS 5, IAS 38, you can refer the revision video of your FR which I have uploaded. With this, can we end the session now? Okay, others. See, if your concepts are good, if you have learned, no, then the revision will not be a headache for you. If here and there concepts are not clear, then this revision will be a headache for you. But do not worry much. Just remember the basic and do this. For employee benefit, just go do one question. And income tax, just do the the share-based payment, and then unused tax losses, leases, and deferred tax treatment for goodwill. The business comment, 4 adjustments you do. Very important. And your financial instrument, please go and do one question regarding impairment loss. Do the question regarding hedge accounting, basic questions, so that you will remember. With this, bye bye. Have a good day. Signing off. Radhe Radhe to everyone.